Good morning, ladies and gentlemen. Welcome to our meeting here of the Investor Advisory Committee. This is our January 21st, 2016 meeting. Thank you for joining us. Those of you on the webcast, thank you for participating as well. The markets might not be off to a very hot start in 2016, but this group is off and running, and we have some pretty interesting discussions today. We have our members here. I'm not sure if there are any IAC members joining us by teleconference this morning. Is anybody on the line, please? A couple had indicated they will probably join at points throughout the meeting. But anyway, again, thank you for being here. First off, and next up, let me just introduce to you Susan Woderko to our meeting as our newest IAC member. She brings a wonderful investor protection background to this work, having served here at the Commission in a lot of different ways and capacities, particularly as the director of the SEC's Office of Investor Education not long ago. She's now the executive director at the Mutual Fund Directors Forum here in Washington, a very well-regarded not-for-profit organization that is focused on the mutual fund industry, the governance, the issues of educating independent directors. So it's great to have you with us, great to have you involved, and we're happy to have you say a few words if you'd like.
If we give you a working mic, right?
Thanks. I just say thank you so much to all of you here. I'm honored to be part of this group. I respect each and every one of you, and I'm looking forward to working with you.
Thank you, Susan, and welcome again. We have four items on the agenda today, excellent topics. We have a discussion about the bond market transparency and structure issues. We have a wonderful discussion teed up, which is an update on the SEC crowdfunding initiatives, the rules that have passed, and as you know, the IAC group has made a recommendation with respect to those proposals back in April of 2014 to try to inform that process. Finally, we have, topically, we have an interesting discussion set out to look at the NASDAQ's proposal to change its listing standards relative to how shareholders, when shareholders vote on particular business combination issues. So we'll talk about that as well. And also we have a recommendation coming from our investor as owners subcommittee relating to FASB's proposals to amend the rules around material disclosures by issuers. So more on all of those later on. We have a crowded agenda, but we will get everybody out of here long before the snowstorm, I hope. As we always do, we're delighted to have opening remarks from the commissioners that attend our meetings and are able to attend today. And we'll have an update from Rick Fleming, who leads the Office of Investor Advocate. So without further ado, Chair White, thank you for being here.
Thank you very much, and good morning, everyone. Thank you all for being here, I guess, between storms, it seems like. And let me just, Happy New Year to everybody, and let me just reiterate Kurt's welcome to Susan and our appreciation for your willingness to serve. I mean, you could be a great addition and contributor to the committee, so thank you very much. I know you all have lots of things to do in your day lives, too, so we appreciate everybody's service a great deal. So what I'll do is customary for me, is to really give you a brief update since your last meeting on some of our activities. I think your last meeting was October 15th, and we've continued to be quite busy. At the end of October, as you know, the Commission approved our last major Jobs Act rulemaking when we adopted the crowdfunding rules, obviously a very important topic that is on your agenda today. Regulation crowdfunding becomes effective in May, and funding portals can begin to register with the Commission later this month. The Commission also, in late October, published for public comment the FINRA rules that will enable funding portals to begin operating. And I want to thank this committee in particular for your very helpful recommendations, which were considered in developing the final rule, and they're addressed either in the release or the rule. Also at our meeting in October, the Commission proposed rules to amend Securities Act Rules 147 and 504. The proposal for Rule 147 would modernize this rule for intrastate offerings by establishing a new exemption to facilitate capital formation through local and regional offerings. The proposal for Rule 504, Regulation D, would increase the aggregate amount of securities that may be offered and sold in any 12-month period from $1 million to $5 million and would disqualify certain bad actors from participation in such offerings. The proposed rules are designed to enhance especially smaller issuers' ability to engage in local and regional offerings, including through state-based crowdfunding laws, while maintaining obviously important investor protections. And as I mentioned, the Rule 504 proposal, I think this may have come up yesterday, contains a bad actor disqualification. So that is there as well. In November, the Commission addressed another important topic, alternative trading systems, ATSs. The Commission specifically issued a proposal to update our regulation of ATSs that trade equity securities listed on national securities exchanges. The objective of this proposal is to facilitate much-needed transparency for investors and regulators alike about how these ATSs operate and the potential conflicts of interest that may be present when the business interests of the broker-dealer operator may compete with the interests of market participants that access the ATS. In December, the Commission considered and approved proposals on the use of derivatives by investment companies and on disclosure by resource extraction issuers. Also in December, as you know, the staff published its report on the accredited investor definition, a subject, again, on which this committee has made very helpful recommendations. The review, mandated by the Dodd-Frank Act, analyzes various approaches for modifying the definition, and I look forward to receiving comments on the report, which will help inform the Commission as it considers possible changes to the definition. Also in December, Congress enacted the FAST Act, which contains a number of provisions relating to the federal securities laws. Last week, the Commission approved interim final rules to implement 2 of those provisions, those allowing smaller reporting companies to incorporate future filings by reference on Form S-1, and those permitting emerging growth companies to omit certain historical period financial statements from a registration statement if the information would not be required at the time of the anticipated offering. The FAST Act also contained provisions relating to reviewing and revising disclosure requirements in Regulation SK, which we will be evaluating in connection with our ongoing work on disclosure effectiveness. I guess I'll mention one other year-end action, and that was our staff's published analysis of the events of August 24th. As I noted at your last meeting, we're closely reviewing how ETPs trade in the secondary market with a keen focus, among others, but on the events of August 24th as an important case study for evaluating our equity markets under those conditions. The staff actually published its analysis on December 29th. We just keep working right through the holidays. And it basically provides an overview of the performance of broad market indices, a comparison of the trading of corporate stocks and exchange-traded products, and an evaluation of certain aspects of the opening and reopening processes at primary listing exchanges. The staff analysis also examines the operation of the limit up, limit down plan and the associated self-regulatory organization rules, as well as exchange-traded products and their idiosyncratic trading characteristics. The publication of this analysis is intended to inform the continuing public discussion on equity market structure, which the Commission, this committee, and our Equity Market Structure Committee continue to study as we consider potential enhancements. Obviously, we continue to welcome your attention and perspective on all of these issues. As Kurt has sort of outlined, and as usual, your agenda is focused on a number of important topics. One item that is particularly critical is the discussion regarding fixed income market structure and pre-trade price transparency. As you know, the Commission, FINRA, and the MSRB continue to consider policy reforms in the enormously important corporate bond and municipal securities markets. Your agenda also today includes a discussion of outstanding FASB proposals emanating from its disclosure framework project related in part to materiality and other disclosure issues. Since FASB's proposals are out for comment currently and they are continuing their due process, it would not be appropriate for me to comment on the proposals, but I will say that I'm glad to see that FASB plans to hold a roundtable later on this year on their various outstanding disclosure proposals. I think further discussion to ensure that all perspectives are fully considered should be helpful as they continue to work on these subjects. You're also discussing a recent NASDAQ request for comment regarding shareholder approvals for various corporate actions another important topic for investors, which I'm glad this committee is considering. The Commission, of course, as you know, carefully reviews proposed changes in listing standards for consistency with applicable requirements as part of our mission to protect investors. So I will stop there, and by thanking all of you again for your service and really dedication to this committee and the assistance, and it really is invaluable assistance to the Commission. So thank you.
Thank you very much, Chair. I know you have to leave, and thank you for being here with us this morning.
2 more minutes, so.
Commissioner Piwowar.
Thank you, Kurt. Kara, do you want to go? Or? Okay. All right. Thanks. And I also want to add my welcome to Susan. I guess that we should say welcome back to the Commission. Having worked with Susan in my prior stint here, it's great to see you back, and look forward to your contributions on the committee. And thanks to all of the committee members for giving up your time and energy on behalf of investors. As always, Rick Fleming and his staff have put together an excellent agenda covering a number of interesting topics, some of which Chair White and Kurt already talked about. One particular topic, the fixed income market structure, grabbed my attention. As most of you know, it's an area that's been near and dear to my heart for some time. Much of my prior stint at the Commission as a staff economist was spent researching fixed income market structure issues. Part of what made that research so fascinating, and what continues to fascinate me and intrigue me about the bond markets, are the ways in which they operate so differently from the equity markets that take up the bulk of the Commission's attention. In some cases, these differences highlight areas where greater regulatory attention is warranted. To that end, I'm pleased that we've seen recent progress on two key initiatives for the fixed income markets. First, following on the heels of the Municipal Securities Rulemaking Board's adopting a best execution requirement for municipal securities, the MSRB and FINRA recently published coordinated guidance on how best execution standard applies to fixed income products. Second, both the MSRB and FINRA have proposed rules requiring the disclosure of markups and markdowns on riskless principal transactions. While these rules have not yet been finalized, I'm encouraged by the recent conversations with both MSRB and FINRA, in which each has indicated a desire to move towards adoption. In particular, I'm pleased to hear that these two groups seem to be coalescing around a common approach to the issue. Adoption of a consistent markup disclosure rule at the MSRB and FINRA would be a huge win for investors and the fixed income markets as a whole. It is my hope that the positive momentum created by these two developments will carry over to an additional area of the fixed income markets where enhancements are needed: pre-trade transparency. I've spoken on the need for this type of transparency in the past, and I look forward to hearing today's panel discussion on the topic. I'm particularly eager to hear today's discussion on the topic because the panel includes one of the, if not the, leading expert on bond market structure, Professor Larry Harris. Some of you may wonder why I'm making that statement. Am I making it merely because he's returning as an SEC chief economist, or because he was in fact my boss at the SEC when I was here before, when I first undertook research in the fixed income markets? But I assure you that's not the case. Rather, I mention it because Larry's consistently impactful research often drives both academic and policy conversations related to the financial markets. Not surprisingly, his current paper on bond market trading, which I trust he will share with you during his presentation, has generated a great deal of discussion on the topic of bond market structure. In addition to Professor Harris, a number of academics and market participants have also identified the need for greater transparency in the fixed income markets. For example, last summer, the Financial Economists Roundtable, a group of senior financial economists, published a statement calling for pre-trade transparency in the bond markets. I've also heard from market participants about their frustrations with the lack of transparency in these markets, including experiences such as having their orders seemingly traded through after attempting to transact on exchange electronic platforms. The empirical and anecdotal evidence of trade-throughs raises legitimate questions about whether the current fixed income markets are working appropriately for all market participants. Given that two key pillars of the Commission's mission are to protect investors and maintain fair, orderly, and efficient markets, issues related to the transparency in fixed income markets are precisely where the Commission should focus its attention. Of course, I would be remiss in calling for the Commission to focus attention in this area if I did not acknowledge the excellent work already being done by SEC staff, and I see Tom Eady's back here in the audience as one of the staff members, currently looking at the question of how we might achieve greater pre-trade transparency in the bond markets. I look forward to working with our staff, members of the Investment Advisory Committee, market participants, academic researchers, and my fellow commissioners to chart a path ahead on this important issue. Thank you.
Thank you, Commissioner. Having survived Metro this morning, Commissioner Stein is with us. I'm sorry. Thank you.
Thank you. My Metro stop closed down this morning. I'm not exactly sure why. I had to take a bus north to get on the Metro and then come down, so I'm sorry I'm a little bit late. But those of you who live in D.C. probably have great empathy for that. I know, wait till tomorrow. This was the 1-inch. I want to thank everyone who made it here this morning. As always, I appreciate greatly how much time and effort it takes to be part of this advisory committee. Your input is invaluable to the regulatory process and the work we're doing at the Commission on behalf of the American people. Today's agenda covers some important and significant issues across a spectrum of investor concerns, including transparency and market structure in the fixed income market, the Financial Accounting Standard Board's exposure draft, removing its definition of materiality, and exchange listing standards. First, I'd like to applaud you for continuing the conversation on fixed income market structure and transparency. There's been a lot of discussion by commissioners over a number of years about the transparency and the structure of our fixed income markets. In July 2012, the Commission issued a report on the municipal securities market, which included a number of recommendations and initiatives to help improve the nearly multi-trillion-dollar municipal securities market. The recommendations address concerns raised by market participants and others in public field hearings and meetings. In 2013, the Commission held a roundtable on the issues in the fixed income markets. So I am hopeful that, like my colleagues here, that in 2016 it'll be a year where there is increased transparency and it becomes a reality. I'm looking forward to the committee's important work and thoughts on this issue. The next item on your agenda concerns a proposal by the Financial Accounting Standards Board, or the FASB, to remove its definition of materiality in addition to a change in its standards related to assessments of materiality. Materiality, I'm a lawyer, so I think materiality determinations are incredibly important, but they tend to be opaque. Companies rarely disclose the quantitative or qualitative factors that guide their materiality assessments. Auditors charged with their own assessments of materiality also do not tell investors how they undertake this charge. Some have become concerned about the FASB's proposal because it seems to emerge from a sense that companies are required to disclose too much information that is not useful to investors. Despite living in an era of big data, the financial crisis made it apparent that there were data gaps and an opacity in certain parts of the market that fueled uncertainty. Ultimately, this helped to spark fear, which froze the credit markets, and the government had to take unprecedented measures to stabilize our financial system. In response, regulators and industry have worked to improve data aggregation and usability in our global markets. For example, the development of a legal entity identifier, or LEI, will help firms and markets evaluate the connectedness of firms in our markets. Rather than limiting information and data, industry and regulators have come together to increase transparency and utility. So I'm very happy to see this item added to the committee's agenda. An investor-centric approach and perspective is incredibly important, and I look forward to listening to the discussion today. Finally, you'll be discussing NASDAQ listing standards related to shareholder approval rules. The SRO rule filing process is critical to investor protection. However, the increasing number and complexity of these rules requires greater resources by investors and by the SEC staff. In fiscal year 2015, approximately 1,750 proposed rule changes were filed by SROs, including the exchanges, FINRA, and the clearing agencies. This was a 10% increase over the previous year. While most of the rules are immediately effective, a significant number of them, nearly 500, were subject to notice and comment and review by the SEC staff. In addition, these rules don't necessarily operate in isolation. One rule template may be copied by others, or it may conflict with the way they operate on one exchange versus another. So I want to take a moment to applaud the work of the SEC's investor advocate in this area. Recently, Rick Fleming has brought focus on the rule filing process through his recommendation to disapprove one rule and supporting the approval of another. We tend to focus on each individual rule as if it operates in isolation, but we need to remember they do not. So I would like to see a comprehensive review of the current rules and whether the incremental changes that are being made are actually increasing market complexity, fragmentation, or resulting in a less than optimal operation of our securities market. Are there ways to improve the rule filing process, and if so, how? I look forward to your discussion on this and other important issues, and thank you again for listening to my opening remarks.
Thank you very much, all three of you. We very much appreciate you being here and showing your interest in this group very much. So thanks again. Mr. Fleming.
Thanks. I'll just be very brief. I just want to again thank my staff and the other folks from around the Commission that do all the work to put events like this together. They do a really excellent job at it, and I appreciate that. Also want to thank the Commissioners for not only making time this morning to come and share their thoughts with you, but the attention that they give to the work of the Investor Advisory Committee and the priority that they make to stay engaged on these issues and follow the work of the committee. And then finally, I'll just remind everyone that any words out of my mouth or anyone else that works at the SEC are our own and don't necessarily reflect the views of the Commission or anyone else on the staff. So keep that in mind as anyone from the SEC speaks today. Thanks.
All right, thank you again very much. Our next item on the agenda is approval of the minutes of the previous meeting. You have a draft of those minutes from the October 15th meeting in front of you. Are there any questions, changes, suggested edits to those? Hearing none, I would entertain a motion to approve those minutes. Approved. Is there a second? Second. All those in favor? Aye. Anybody opposed? Any abstains? One abstention. Since you were not here at the point. Very, very good. Susan Wooderico abstains, having only now become a member. So approved as written. So we can move into our next activity here, which is our first topical discussion this morning. This has been the discussion of fixed income market structure and pre-trade transparency. This item has been very long-standing discussion and debate around the structure and the functioning and the transparency of bond markets. Should they be more like equity markets? Why aren't they? What are the issues? So forth and so on. We put a lot of interesting pre-read information into your board package this go-around. I hope you found that useful and informative. It boils down to a question about the level of transparency and essentially the fairness to investors in these markets, which are very fragmented, and with respect to that fragmentation and lack of transparency, can that serve to unfairly benefit intermediaries and likewise disadvantage the investor? We have two highly regarded experts on that topic with us today. We're very lucky to have Larry Harris, who, as Commissioner Piwowar mentioned, is the former SEC chief economist and now a professor in the business school at the University of Southern California. Thank you for being here. I'm sorry that we have not given you a little bit better weather to accommodate that. He has written extensively on this matter in various forums and advocates for an order display requirement in the fixed income markets that could substantially improve market quality for both retail and institutional investors. And next to Larry is Craig A. Noble. He's the Managing Director and Head of Capital Markets for Wells Fargo Advisors. Thank you for being here. Former Vice Chairman of the Board of the Bond Dealers Association of America and a former member of the Board of Directors of the Municipal Securities Rulemaking Board, the MSRB. So very impressive background. Craig has concerns about such a move and has a long history of standard setting and has certainly very familiar with the issues of taking into account investor protections in these markets and the quality and functioning of markets. So thank you both very much for being here. I don't care, whoever would like to start is fine.
I guess it's me. Thank you very much for having me here. Mike Pivovar's extraordinarily kind introduction, exaggerated as it was, put me in mind of comments I once heard from Warren Buffett. So Buffett was talking to a bunch of students, as he likes to do, and he talked about what it takes to be happy in your marriage. And he says the key to a successful marriage is to marry somebody with very low expectations. Having heard Mike's kind comments, I'm now worried. Before I start, let me disclaim my own remarks. You may know that I'm a director for Interactive Brokers, but I don't speak for them or for USC. Both entities are entities that I believe would benefit from the proposals that I'm going to talk about. My interest in these topics long predates my affiliation with Interactive Brokers, and of course Interactive Brokers has not put me up to this or anything, but they did supply data that was useful to doing this research, and for that I certainly appreciate it. I'm going to start with a telling observation, and then I'll turn to the substance of my talk. Exchange-listed bond trading was very liquid at the New York Stock Exchange through the 1920s for municipal securities and through the 1940s for corporate bonds. So long before the invention of computers and order routing systems that were automated and whatnot, we had exchange-listed trading systems operating for bonds, and the bonds were trading rather successfully. Now here's the remarkable thing. A study that was done by Bruno Billet and Rick Green a few years ago showed that the transaction costs at that time were substantially lower than they are now. Okay, so transaction costs in exchange-listed trading system, trading what we understand to be bonds, were substantially lower more than a century ago, or a century ago. So keep that in mind as we go forward. Okay, so I want to talk about the issues. The primary issue with respect to this market structure could be phrased or framed in the following way. And that's with respect to the question of when are broker-dealers brokers and when are they dealers. As you all know, broker-dealers trade net and they profit from their markups. Few broker-dealers act as pure agency brokers who profit only from their commissions, though there are a couple. Markups on riskless principal trades are identical to adding commissions to they're the same thing as a commission. Okay, so a riskless principal trade is a situation where you've got a broker-dealer standing between a buyer and seller where they're both identified, he's identified, and he just takes the position of one and passes it along to another. That's a brokerage function, that's not a dealing function, and we normally have commissions that are charged for that service. But it's equally possible to just have markups, and they're essentially the same. So broker-dealers who arrange riskless principal trades when filling their customer orders are acting as brokers. Now, unlike commissions, though, customers don't see the dealer markups before they trade. So now you go to a broker, you can ask for their commission schedule, and you can see exactly what it is, and the dealers compete on their commission schedules. You can sort of see what the markups are after the fact by examining trace data or the similar data from MSRB, but doing so is time intensive, and most investors don't know how to do this, certainly not the retail. Customers generally don't see the best bid and offer prices before they trade. If they want to have some sense of where the market is and compare people, dealers, they have to query multiple dealers, and that's really prohibitively expensive for small traders. Okay. In these markets, there's a related question of who can offer liquidity. Most investors can't effectively offer liquidity in these dealer markets, even though there are many electronic order-driven venues, exchange-like systems out there. Those systems are almost exclusively available to dealers and some large institutions, but not to small people unless they go through a few brokers that give them access, but most of them don't. There are no trade-through rules that protect standing orders, so when people place a standing order to buy or to sell, it's not exposed to the market as a whole, it's just exposed to a dealer. And few brokers will allow customers to use these venues, and the reason why is that most broker-dealers are either profiting directly from the markups that they're charging to their customers, or they're profiting indirectly from the payments for order flow that they obtained from dealers to whom they are sending their retail orders. And those payments for order flow are quite substantial. Both of these processes make them reluctant to adopt innovative trading technologies. A couple broker-dealers have, including Interactive. Well, the net result is that small traders and many institutional traders trade at a disadvantage because they don't know market prices as well as dealers do. It's a disadvantage to dealers, and you know there's always been such a disadvantage, but the question is that should it persist into the 21st century? Transaction costs are high in bond markets in comparison to transaction costs in equities, and risk considerations would suggest the opposite. Normally, transaction costs are higher for risky securities. And of course, buy-side traders cannot easily offer liquidity to other buy-side traders. Investors can't meet investors when they both have a common interest, with one wanting to buy and another wanting to sell. And that's what makes transaction costs so low in the highly volatile electronic equity markets that we see. So I want to talk to you a little bit about a study that I did over the summer that puts a fair amount of light on some of these issues. Okay, so what I did in this study is I took about 3 million trades on TRACE, essentially a complete record of all corporate bond trading, and I compared those trades to almost 500 million top-of-the-book quotes that I obtained from Interactive Brokers. Interactive Brokers acts as a pure agency broker for its clients in the fixed income markets. And the way they do this is that they collect the best bids and offers from a number of electronic venues and from a number of electronic dealers who have assembled offers or indications of willingness to trade by various entities. And they've assembled that into what would be essentially characterized as a private national best bidder offer for the fixed income market. So there is no MBBO for fixed income, but Interactive Brokers has essentially assembled that. And the reason they did that is because they want to ensure that their clients get the best available price. They're not the only people doing this, but they're certainly the largest by far. So they gave me this record, and so I have the MBBO from the fixed income market, and what I'm seeing is essentially what the dealers are seeing. Okay? And I use this to measure transaction costs, to identify trade-throughs, and to determine which trade-throughs are riskless principal trades. So a trade-through, as you're probably all aware, is a situation where you have somebody, say, offering to sell at 100, and a trade is arranged at 101. Well, the buyer on that trade certainly would have preferred to have bought at 100 instead of 101. When that situation happens and you see a trade like that, then that's called a trade-through. Okay, so what did I learn? Well, here are the main empirical results. Okay, first of all, markets are increasingly electronic. When I went into this, I thought, you know, the bond markets are still in the 1900s or even earlier, the 19th century. But instead, I learned that they actually are quite electronic. But the electronic systems, essentially exchange systems that are out there, are primarily accessible only by the dealers. The median bond had a bid or an offer present for about 99% of the time for bids, and 77% of the time for offers. And that's measured as a fraction of the trading day starting from when the system opens, 8 o'clock, to when it closes, I think 5:30 or something like that. Of course, most of the action's between 9:30 and 4 or 5. 10% of the bonds had a two-sided market more than 99% of the trading day. Many of these bonds really look like small or mid-cap NASDAQ stocks from, say, the 1980s. 1% of them, 230 bonds or so, traded more than 22 times per day on average. Okay, so this is looking a lot like NASDAQ from 30 years ago in equities, and it shouldn't be too surprising because it turns out that the two systems are essentially identical. Bond markets and NASDAQ trading from 30 years ago, the market structure are very, very similar. They're dealer markets. The only difference being that 30 years ago, the dealer resources for communicating with each other through ECNs and other exchange-like vehicles were not nearly as well developed as they are now in fixed income markets. So transaction costs, here we go. The average customer round-trip transaction cost was 125 basis points. And I could figure out what the transaction costs were by comparing the midpoint of the bid-ask spread to the trade price. This is a standard technique for measuring transaction costs. Everybody uses this technique. So what's 125 basis points? 125 basis points is 4 months of interest for a 4% bond. So if you buy a 4% bond and decide that you need to sell it, okay, if you sell it before 4 months have passed by, you've lost on the transaction. Okay, that's an awful lot of transaction costs. Another way to look at it is ask, what would that transaction cost look like if we projected it into, say, a $40 stock? So for a $40 stock to have transaction costs like that, you'd be looking at a bid-ask spread of 50 cents per share. It's been a long time since we saw 50 cent per share bid-ask spreads on most stocks, even small stocks or some of the smaller mid-caps. When did we last see that? Well, not going to surprise you. We last saw spreads like that when we were looking at NASDAQ stocks from 30 years ago before the order handling rules were adopted. It's the order handling rules that changed the NASDAQ markets, equity markets, and those rules could do the same in the fixed income markets. Recent studies from the New York Fed using cruder but still highly reliable methods show that these transaction costs have been declining, which is really good news. If you're interested in that, look at their Liberty Street blog. The reason they're declining is because there's a lot of electronic dealing similar to the high-frequency trading that we see in the equity markets, which is providing liquidity to these markets. And that dealing is taking place in these ECNs that are behind the dealers, that the dealers are relying upon. So now let's talk about trade-through frequencies. And this I found astounding, and it will partially explain it, though. 47% of all trades, almost half of all trades trade through a standing quote when there was a two-sided quote standing for more than 2 seconds. So the 2-second, I ask that a quote be standing for more than 2 seconds before I wonder whether there's a trade-through, because I want to see, could it have been accessible? I mean, could somebody, who wanted to reach it, get to it? 47% of all trades traded through a standing quote. Many of those trade-throughs, of course, are due to net pricing. So say that there's a 101 quote to sell in a ECN, and a dealer picks up that quote when trying to buy on behalf of his client, and then marks up the price a little bit, and we'll see two prints. We'll see the dealer trading at the ECN to pick up the inventory, and then we'll see the dealer selling that inventory to the client at a slight markup. Or, well, that's the question. Is it slight or not? Okay, so the second trade is going to trade through the first quote if the first quote is still standing. So we'll have a trade at 101, and then we'll have another trade at 101 plus a markup, and that'll be a trade through. And that certainly accounts for a good portion of the trade throughs. But now the question is, what is the price disimprovement, the markup that's associated with that second trade? Okay, so it turns out that price disimprovements is much greater than normal commissions. So the price disimprovement is the difference between the second trade price and the quoted price. That's the distance through which there was a trade through. So let's look at only those trades where the price disimprovement was greater than, say, 10 basis points. So 10 basis points is sort of a typical commission. It's even high for equities. And we could argue that it should be lower, maybe it should be a little higher, who knows. You could argue one way or the other, but we don't need to go in that argument, because if you filter by 10 basis points, throw out all the trade-throughs that had a smaller disimprovement than 10 basis points, you still have an average 77 basis point disimprovement for 31% of all trades. So there are 31% of all trades were trade-throughs for which the markup was greater than 10 basis points. And for those trades, 77 basis point disimprovement. That's a whole lot larger than anybody's concept of what commissions should be. Now, I, of course, have an opinion about what commissions should be. I don't think that the SEC should be imposing their opinions about that, or anybody else. Commissions should be determined in a free market, but they should be determined in competition where people actually see what they're paying, because that's how competition works. And that just strikes me as a very large number. Okay, so now let's talk about riskless principal trades. Using methods that are now, again, fairly well established, I was able to look at the transaction record and identify with a fair degree of confidence which trades were riskless principal trades. I didn't actually see that a dealer bought and then immediately sold, because I didn't see the names of the dealers, but from the context and the nature of the market, you can very reliably identify situations where you see two trades occurring for the same size in the same security, where there are no other trades adjacent. The two trades are within a minute of each other. More generally, they're within 2 seconds or even less than 1 second of each other. And I found that 42% of all these riskless principal trades, all reported trades appear to be riskless principal pairs, for which the time between trades is less than a minute. Okay, so it appears that there are an awful lot of riskless principal trades out there. Now, some of them may have been situations where, well, I was going to suggest that there was some dealing involved in it, but there may have been situations where the broker spent a lot of time finding one side and the other side, and then just reported both trades at the same time. But in those situations, it's still a brokerage function. You don't have a situation where the dealer's actually holding inventory. Less than 2 seconds separate the trades in 73% of these pairs. So 73% of the 42% of all reported trades appear to be riskless principal trades, for which the time between the trades was less than 2 seconds. The 46% of these riskless principal trades have no markup. Those are probably agency trades by interactive brokers and others, and perhaps commission trades that are also being reported. The average markup for the non-zero riskless principal trades was 54 basis points. And the total transaction costs, of course, are higher because it should be measured from the midpoint of the bid-ask spread. The total markup value was $2/3 of $1 billion for the year. Okay, so 32% of these trade-throughs are also non-zero markup on riskless principal trades. Okay, so if we look at the trade-throughs and ask how many of these are riskless principal trades, it's 32%. The dealers are acting as brokers. So a couple quick full-year projections. I'm aware that I want to finish up. Total transaction costs were about $26 billion in this market. This is what investors paid for liquidity. The total trade-through value is about $700 million. This is how much investors could have recovered had they been able to trade at those prices, but then they would have had to pay commissions, which would be an offset. Okay, but it's still a lot of money. So a couple quick policy recommendations. I think at a minimum, FINRA should require that brokers disclose their riskless principal trade markup rates on a pre-trade basis. They really should be disclosing, they should be quoting these things as commissions and not doing markups, but certainly on a post-trade basis, and FINRA and MSRB are proposing to have post-trade disclosure. I think that the bond markets would very substantially benefit from having a national best bidder offer facility. It may be created privately, but it would certainly have a lot more credibility if it were just mandated and done properly, as we do in the equity markets. We can certainly get better market structure, and we could do that by adopting order handling rules, enacting a trade-through rule for bonds, requiring that dealers post their limit orders of willing customers to order display facilities that widely disseminate these prices. This allow anybody to trade. They should do this, we should do this before the class action attorneys do this for us, because that's basically how we got the Manning ruling for equities. It's likely to come in bonds. So competition always improves prices. Any investor could effectively offer liquidity in an order display facility, so we'd have investors competing with dealers. That might hurt dealers, of course, but I'm not too worried about that. Dealers will generally do well. National exposure of orders will allow any dealer or buy-side trader to fill these orders, so it'll give more opportunity also to dealers. And as we've mentioned, similar order handling rules vastly improve the NASDAQ markets. So in conclusion, the bond markets are increasingly electronic. We know that the spreads are narrowing, which is good, but the markups remain really high. Small changes by FINRA, NMSRB, or SEC could substantially increase liquidity provision by the buy-side traders, and that would ultimately lower issuer funding costs, which is really what we're most concerned about, I think. So a couple quick comments. My guess is that if we adopted similar order handling rules as we've done in the NASDAQ markets, we would probably lower transaction costs by about 20% at least, okay? And the reason I believe that is because when transaction costs were lowered by order handling rules in the NASDAQ markets, volumes increased very substantially by more than 20%. And we also measured the difference in transaction costs, and it was certainly greater than 20%. Interestingly, the total amount that people seem to be willing to pay to trade seems to be about constant in across all sorts of instruments. All academic studies suggest that if you lower transaction costs, say by 20%, people end up trading 20% more. Well, that's up to the individual investor and others to figure out why they want to trade. But that's really good news for dealers. What it says is that if these changes were adopted, there's still going to be a substantial market for dealers, as we'd expect, because the volumes are going to increase. It may not be the same dealers as we presently have, because as we've seen in the electronic markets and equities, that high-frequency traders have taken over many of the traditional dealing functions that we saw from floor-based specialists and other dealers. But their quality of service offered to the public vastly, vastly improved. So I appreciate your attention to these issues. I know that these markets will ultimately change. The only question now is how will we affect those changes? Will we do it gradually, by incrementally changing market structure as we did for the equity markets, every 5 years adopting one more order handling rule to improve things? Or might we do it with a pilot study with the following observation, that our most actively traded bonds look exactly like small and mid-cap stocks. Small and mid-cap stocks trade very well in under the order handling rules that are now associated with modern trading in the 21st century. Why not place the top 200 bonds into that type of environment and see how they trade? I can, as an academic who studied these markets for a long time, I can assure you they're going to trade just like you'd expect them to, like the securities that already trade in those markets. If that works, then we just bring in more bonds until we've solved the problem, or until we see that there are certain bonds that really need to trade the way they presently trade. That seems to me the proper way to incrementally adopt change in these markets. Well, thank you very much for your attention.
Good morning, and I want to thank, need to turn that on, sorry. Good morning, and I want to thank the Commission and members of the Investor Advisory Committee for this opportunity to speak today. I work in the equity and debt capital markets daily. As mentioned, I'm a former board member of the MSRB and currently on the FINRA Fixed Income Committee. And I hope to add insights in the trading costs in both these unique marketplaces. I'm testifying today on behalf of the Bond Dealers of America. The BDA is the only DC-based association exclusively representing the markets and regional securities firms, and that are active in the fixed income markets. The core mission of the BDA since its founding in 2008 has been to foster competitive, transparent capital markets that benefit all participants, including the retail investors and corporate and municipal bond issuers. I work for Wells Fargo, Wells Fargo Advisors, a non-bank subsidiary of Wells Fargo Company. We provide advisory services, asset management, brokerage services, and other investor services to investors. Wells Fargo employs 15,000 full-service advisors and administers approximately $1.4 trillion of client assets. At Wells Fargo, we take pride in the fact that we provide clients with the benefit and structures of a large-scale firm while retaining the personalized client focus of a small regional firm. My comments today will focus on the state of the U.S. fixed income markets. The marketplace is currently being shaped by regulatory and technology transformation. I think it's important to acknowledge that the significant amount of regulatory change has taken place in the last few years. New rules such as the MSRB Best Execution Rule and strict enforcement of existing FINRA rules have designed to ensure fair prices, reasonable dealer compensation, and have supported a long-term trend of narrowing fixed income spreads while ensuring that dealers take great care to implement and follow the detailed policies and procedures for ensuring quality execution of client orders under all market conditions. Investors are currently benefiting from these rules. As stated in Mr. Harris's presentation, markups have been greatly reduced, and while higher markup outliers do exist, trading data demonstrates that markups have narrowed, and in fact the market is not as uncompetitive as some critics have noted. Any BDA dealer will tell you that the market conditions have been tough. Competition for retail and institutional order flow is strong, and that in order to compete, a dealer has to devote significant resources to technology. To be successful, these dealers need to have both significant technology and significant volumes of trades, along with personnel to handle those trades. I'd like to put markups into context of hard cost to the dealer versus investment strategies. If a dealer buys 20 10-year bonds at par and mature, and these 20 bonds sell it to a retail investor at 101, the dealer makes a gross profit of $200. Out of that gross profit, the dealer has to create a customer account, send a customer statement, and pay a retail broker. They must notify the customer of any corporate actions or material events the dealer needs to do this for the 10 years the bond is out there, all for the $200 gross profit. Compared this fee structure to a mutual fund, which will charge 1% annually, along with anywhere between a 2.5% and 3% fee when you buy the mutual fund. Additionally, for full-service retail accounts, the transaction cost for $100,000 of purchase of Apple stock versus the purchase of 100,000 Apple bonds would be roughly the same when measured by stock commissions and bond markup. What seems to be missing is the fact that, yes, bond markup is inclusive or could be inclusive in commissions, but when we look at the total spread, it gets lost in the fact that if you buy a stock, you have a commission that's outside and disclosed, no question about it, but the markup there is also, as part of the bond price, similar in compensation to the broker or the dealer. The BDA encourages the Commission to think very carefully about the market, about the unintended consequences of regulated-driven as opposed to market-driven pre-price transparency. The SEC Chair, Mary Jo White, noted in her 2014 speech to the Economic Club of New York, the Commission must be mindful to strike the right balance by compelling the disclosure of meaningful pre-price information without discouraging market participants from producing it because of the concerns that will compromise trading positions. The issue here is, and a large part of our conversations have to do with, how is that marketplace in place? If you are a broker-dealer that owns and offers bonds, we own and offer bonds. Very few equity trading shops actually take positions, and we understand that that's the large difference between our marketplace and the equity marketplace. And Larry very succinctly points out that if we had a meeting place where those transactions could meet, similar to equities, it would facilitate greater transparency. Part of the problem is the fact that we've mentioned time and time again that there are the number of CUSIPs involved in municipal transactions and corporate transactions. 1.2 million municipal CUSIPs are available at any one time, and about 40,000 corporate CUSIPs are available. Take this into effect that in the active marketplaces in the equity market, it's about 7,800 actively traded stocks when you exclude the pink sheets or gray market equities. So we're talking about a totally different marketplace, and as stated, it's easy to find a buyer and a seller when you have a smaller marketplace. And I don't disagree with Larry that if you took the 200 actively traded, say, corporate bonds and put them in a marketplace, that you could probably facilitate some kind of trading back and forth. But most of that trading is going to happen, I have to be fair to say, not between individual investors. It's going to happen between the larger institutional clients who are already benefiting from narrower spreads as before. I would prefer a market that had innovation, including increased visibility of executed limit orders. But the result of natural changes in the preference of market participants in the fixed income marketplace, I think these innovations and technology changes are already impacting the bond market today, possibly not as fast as most people would. For example, while the volume of electronic trading in fixed income is relatively low, 20% of overall trading volume electronically trading, but they're growing at a rate of 25% a year. I think Larry stated that we have seen a fair amount of increase in electronic trading, according to Greenwich Associates. And 3/4 of fixed income investors now trade online, compared to 1/3 that traded as little as a decade ago. So the market is changing on its own, and market participants are competing for service retail clients, and retail clients are benefiting. It would be a mistake for the SEC to impose a Reg NMS-style market structure on the fixed income markets. Professor Harris and others correctly noted fixed income securities are less risky, both from a credit risk and a capital structure. However, U.S. bond issuers benefit from being able to market debt to a wide variety of investors. Increased marketability to the buy and hold for long-term investors result in a variety of structures, maturities, and timing of issuances, all of which result in reduced interest costs to issuers. As I stated before, there are currently 1 million unique municipal securities worth over $4 trillion and over 40,000 corporate bonds worth over $15 trillion. Many of these bonds, especially in municipal securities, trade infrequently because bond investors buy and hold their securities. They're not trading them before maturity. Also, it's worth noting that the credit analysis is far more nuanced with company-specific analysis such as macro analysis of the stock market. Every credit requires different significant analysis, especially in the municipal market. Additional due to the facts that bonds trade less frequently than stocks, market making and cost and risk of providing liquidity is different. When a market maker bids on a bond, it is the knowledge that the risk that he may have to utilize his balance sheet to carry the bond for an undetermined amount of time. There's a low level of position risk in an equity trade. Investors buy and sell equities with greater frequency than bonds. This represents the reality in the marketplace for fixed income. The equity market makers operate in a far more actively marketplace. The risk impact, these risks and track trading costs. Lastly, I want to touch on post-trade disclosures, specifically FINRA's proposed price reference rule and NSRB's proposed markup disclosure rule, which would require dealers to provide retail investors with an additional post-trade pricing disclosures. Wells Fargo advisors and BDA members support the objective of improving price transparency in fixed income markets and applaud the efforts to enhance accessibility of this pricing information to retail investors. However, the BDA members, including Wells Fargo advisors, have expressed serious concerns about the methodologies proposed by both the MSRB and FINRA. The BDA wants to ensure that these disclosures are provided using the most efficient and understandable method possible for retail investors. And the dealers are also encourage regulators to analyze why investors have not consistently utilized TRACE and EMMA before requiring post-trade disclosure. In conclusion, I would encourage that you let the market dynamics shape the market structure. A top-down directive from a regulatory agency should not shape the market for fixed income securities. BDA member firms support price transparency and competition and would urge the Commission to continue to engage large and small investors, issuers, and dealers before mandating a potential disruptive change in the fixed income market structure. Thank you.
Thank you both very much for being here and for your comments. If you have a question, just put your tent card on edge. I do want to give a chance for the folks on the phone. We have 4 of our IAC members on the phone. Barb Roper is with us, Jim Glassman, Roger Ganser and Adam Kanzer are all on the teleconference, so I'll open it up to you folks first if you have any questions for the presenters. Hearing none. Any questions from the group here? Darcy Bradbury.
Forget which one. Oh, there we go. I'm kind of interested in having you talk briefly about how you price a bond, because although there are, as you point out, thousands of different bonds out there, my experience, which is somewhat dated in this marketplace, is that it's typical to just kind of use a little bit of a simplistic grid, or maybe now it's an algorithm, but basically credit rating, maturity, look for comparables, that it's not like dealers are quoting really highly customized prices on all the tens of thousands of bonds. So, but like I say, my experience is a little dated. I haven't been in this marketplace for a while personally. So could you talk a little bit about how bonds are priced in the secondary?
Well, with the advent of the ATSs, it's become a lot easier because the benefit of having, and we take feeds, my traders take feeds from all the ATSs along with having Bloomberg information readily available. So to your point, which is also an interesting fact, is I carry at any time an inventory between $500 to $750 million of bonds on a daily basis. With that, I employ 120 people in the fixed income department, similarly only 60 in my equity department, and I trade about 4,000 fixed income trades a day versus my 150,000 equity trades a day. So the electronic marketplace would make it a lot more efficient for me to do. But we take those trades, we look at the security, we also look at the rating. We also use trace and MSRB data to see what trades have what bonds have traded that have similar characteristics, and with that provide a bid price. If you're looking for prices on the statement, that is actually created by a matrix. There's only two pricing services out there right now, so if you see a statement price, that would probably more than likely come from a matrix, where the prices that I provide would be provided by an actual trader. And using ATSs, EMMA or trace available data, along with what the marketplace is doing, if the Treasury market, what's the Treasury market doing at that time, to formulate what they think is the yield for that bond at that time, and then putting that yield into a price back to you or your financial advisor.
Darcy, your question gets at a very fundamental issue that's very important, which is the following. If we had greater pre-trade transparency, would we damage the price formation process in the bond markets and hurt investors as a consequence? So it's possible to tell very convoluted stories where that would be true, but those stories are extremely convoluted. More generally, we've observed that when there's more transparency, people have a better understanding of how markets work, how the price formation process is working. And informed traders, as long as there's liquidity, informed traders have an opportunity to make money. Prices become informative of values when informed traders do their research and then act on that research. And they're only compensated for their actions when there's liquidity available for them to trade. So the cheaper the liquidity, the more efficient the prices are, the more informative they are. So it's my opinion that greater pre-trade transparency will improve the liquidity of the markets and thereby improve their informativeness. Now that said, there's not a whole lot at risk here, because for most of these securities, though people are very, very concerned about credit risk, for most of these securities, there just isn't that much credit risk. Certainly not for most of the municipalities, though there are exceptions, of course. And if you are concerned about credit risk, the price of credit is discovered primarily in the equity markets for these issuers. And if you're concerned about interest rate risk, the price of interest rate risk is discovered in the treasury markets and in the futures markets. And so that brings us to the following interesting observation. The equity markets that are discovering credit risk, which is far more volatile, are quite transparent and operate with good order handling rules. The treasury markets are very transparent and operate with fairly good order handling rules. And yet somehow when you combine those two risks into the form of a corporate bond, we all of a sudden are in the dark ages. So that's strange.
Thank you. Steve Wallman.
A couple of questions, but let me start with Craig Knoll. In terms of the marketplace itself, as I understand Professor Harris's observations, regardless of the other million CUSIPs out there, there are at least a couple hundred that are relatively liquid that could trade in essence like stocks. People see on a continuous and consistent basis there's a two-sided market, there's relatively more narrow spread, there's an electronic capability to be able to allow communications back and forth. Presumably the names are known. I don't know who the 200 are, but I'll assume that they're well-known names, Apple bonds, things of that nature that people would understand. Is there a reason why, for at least that proposal, the notion of why not carve off the 200 most liquid and have them more subject to an equities type marketplace? Reason not to do that? And then the question in reverse, sort of for Professor Harris, which is, it almost seems like an obvious thing. Why wouldn't the market just solve for that problem itself? It's not terribly hard to come up with something that can show and display 200 CUSIPs and to get prices. And if IB's out there, we're an agency-only broker-dealer as well. We don't take any markups. We don't have inventory on fixed income. There are a whole bunch of folks that would probably be happy to be participating in that, but it hasn't occurred. So the question is, why hasn't it occurred?
And I think that part of the problem is that away from a unified electronic marketplace, and that's part of the problem right now, is there are a number of different ATSs out there. They're all not interconnected. They all, in some cases, display false liquidity because part of the issue there is that I post all my inventory to all, I think I'm out to 5, maybe 6 different ATSs at one time, which would show you that if I own 100 corporate bonds, it would show 100 on bonds.com, on TMC, on BondDesk, on TradeWeb, on PIC, Interactive Brokers. It would be the same 100 bonds would show, which is kind of it helps and helps pricing and also price transparency, that I have the ability to be able to try to get the best market for those bonds when I own them. But there hasn't been a unified electronic marketplace that I could display it in one place. Part of the issue too is, and what's lost in the fact that
sounds like a strong argument for a rule.
And I don't want to go down that path, but part of the issue too is, and what people tend to forget is, each one of these ATSs isn't in the business to be because they're nice guys. They make money. They have board members. They pay board members. They pay participants. It's all, they're in it for the money. I mean, I pay a large amount of ATS fees every month to be able to provide that, which then comes back into some market spread, whatever it is. I'm not saying it would be, the widespread that Larry has been able to figure out between the different securities, but there's a cost for dealing in an ATS, which is, I guess, similar to when I'm trading on the New York Stock Exchange or any other equity marketplaces too. But there isn't any one place that you can go to. Sorry?
So first, a couple of comments to add to Craig's observations that are important to understand these markets. So yes, the dealers do post in a lot of different places, I want to, anybody who's wondering whether my study reflects that fact, I want to assure you that it does. Interactive only reports the size of the largest, of the best market. So if you have two markets showing the same size, showing the same price, your Interactive will only show the size in that one price. So when I was counting trade-throughs and their impact, my count is sensitive to the concerns that Craig raised. But let me raise another concern that Craig would have raised if he had had more time, which is the following, that these ATSs, most of them are not posting firm quotes. Some of them are. So for instance, the New York Stock Exchange was not an ATS, is actually an exchange. Those quotes are really firm. But most of the other systems, they're actually just indications. But here's the good news. So an indication is something that says I'm willing to trade at this price, but if you ask me to do it, I might wiggle out of it because, you know, conditions have changed or something like that. So I've got a study here that's based on indications, not quotes, and that should give us reason, you know, pause for concern. Okay, and but the good news is that virtually all these indications are effectively quotes because the dealers will honor them, except when they're getting hit by hedge funds that are trading on macroeconomic information. And for that, game's off, and literally should be. It's appropriate to withdraw in that case, from my point of view. So now, Steve, to your question, why do we need to regulate? Won't this happen by itself? Okay, so, yeah, if we don't do anything at all, there are a few things that are likely to happen that are good. Okay, so somebody's going to create this national best bidder offer and publish it, probably Bloomberg or others, if the industry allows them to do it. So the industry can decide who they're going to sell data to, and it may be that they just won't do that, though I think that's unlikely. It's possible. Now, we've seen cases where vendors have withheld data from people because their vendors' other customers don't like to have that data published. Entities like interactive brokers will continue to vacuum up all the sophisticated traders who understand these issues. Okay, they've been growing phenomenally, and if you're interested in trading bonds, you go to a person like a dealer like, I'm sorry, broker-dealer or broker like Interactive Brokers, or there's one or two others that do this. But most of them won't give their customers access to these systems, and probably never will because of the payment for order flow and because of the advantages that they obtain from dealing in a dark environment. We know that transparency, you know, sunlight is the best disinfectant. It's not that there's things that need to be disinfected here. There's no evil here. It's just a system that is set up for a different age that is not serving us as well as other systems could. So the real problems are the agency problem associated with the brokers and dealers who have no real incentive and no pressure to change the system. They're compared to other people, not generally to Interactive Brokers and a few other competitors who do provide better prices. There is another argument for intervening. So when we ask government to do things, it has to be for really compelling reasons. They've got to solve problems that the public can't solve themselves. So the vast majority of retail investors and most small institutional investors and even mid-sized institutional investors can't solve some of these problems themselves. They don't have the information, they don't have the knowledge, and so we might intervene on that basis. But there's another reason also. These order handling rules will undoubtedly improve liquidity in the markets. If we improve liquidity in the markets, people will ultimately be willing to pay more for bonds in the primary market, which means it will lower issuing costs for corporations. And that creates a benefit that is external to these markets. That benefit benefits everybody in our economy who depends on corporations to create jobs, to build new things that will make things better for us. And when they have access to cheaper money, then they're able to do more, and that benefits all of us. And this is particularly true for the municipalities, which are under such great pressure now. They have difficulty raising taxes. They've got to do more with less. The way to do more with less is to be able to sell their bonds at higher prices. The way to sell bonds at higher prices is to assure the investor that if they buy the bond and need the money later or lose confidence in the issuer, that they can easily sell it at low cost. Most bonds do get locked up, partly because of investor preferences, but also in large part because it costs so much to sell the bond. When you sell that bond, we talked about before, the round trip is 4 months interest. That's a real disincentive to trading. In the future, as people grow older in our economy, and the demographic trends are very, very obvious, people's preferences change from equities to fixed income. And so this market is of increasing importance to individual investors and to the institutions that are representing the individual investors through the ETFs and through the open-end funds. Anything that we can do to help them will help those people retire with better lives.
I just want to make one comment. A little taken aback by the payment for order flow in the fixed income markets. I don't see payment for order flow. I pay for liquidity. I pay the ATSs for liquidity. I pay Bloomberg to post on PIC for liquidity. I don't get payment for order flow in both my equity marketplace. I don't take any payment for order flow. And I don't do it in the fixed income market. And I think most of the BDA members don't get payment for order flow. It's an unusual comment because I haven't seen it. Not that I wouldn't, if there was a way for me to figure out how to get payment for order flow, it wouldn't have been a better idea to maybe reduce my cost structure. But there is no payment order flow that I see for my equity, for that marketplace. And the second comment is about this thought process on trading bonds. Most investment houses are talking to customers about their retirement, and those strategies, I would hope for most fixed income investors, is a buy and hold strategy. And even though we're talking about what we may think is larger than normal spreads versus the equity market, I am more apt to trade a stock a couple of times in a year than any bond I would hold, and I would hope that any of you who are bond investors would be buying the bond for, of course, the coupon payment that they're going to pay and holding it at least past the first, second, or third, or fourth coupon payment, because that's what most investors buy bonds for, not because the fact that the Fed makes a change in interest rates and my bond that I bought at par is now worth 105, even though I didn't collect a coupon, I can trade it at 105. That's a different philosophy. And I just think that we're looking at it differently, and I know we're not trying to apply equity thought process around fixed income, because we said that time and time again that's what we're trying to do, but we seem to get into this, I need to trade my bonds, and trading bonds are more expensive. Buy a bond, you hold, most of our customers at Wells Fargo Advisors at least, buy bonds and hold bonds to maturity most times. And we do provide the ability to see from a trace and MSRB standpoint for the FA right on the screen. When an FA buys the bond, he can go and see exactly where that bond trades. So I back my trading up to what trace and MSRB are.
Illuminate on the PFOF.
I'm sorry. Yes. Okay, so when we talk about payment for order flow, we're usually talking about dealers paying retail brokers for order flow. So we wouldn't expect that the dealers are receiving payment for order flow, they're actually paying it. Now, whether Wells Fargo is involved in that or not is, I wouldn't know, but I'm aware that a number of retail brokers are selling their customer order flow to dealers, and the dealers can afford to pay for it because they make a lot of money on the markups that they charge, and that relationship is most politely characterized as being cozy. If you wanted to characterize it differently, and I've done so, let's characterize it in the following way. If I were the purchasing officer for USC, and USC told me that they would, some people have heard this before, and USC told me that they want to buy chairs, and I went to all the vendors and said, I have chairs for sale, but if you...
Maybe we could get
yeah,
Craig Knowles.
very quickly.
Craig Knowles, why don't we, Craig Knowles, I think you had a response to that or so. Maybe we should just move on to that.
Let's put it this way. It goes back to the same premise of, and I think where Larry is, and make sure that I am not disparaging any discount brokerage firm, but as we know that the discount brokerage firms, from an equity standpoint, were the benefits of dark pools and payment for order flow. Because you can't trade 100 shares of stock for $9 and make any money, because the cost of just clearing that stock costs you more than $9. So there had to be some way for them to make money, and I think in a large part that you can see some not full-service brokerage firms might do the exact same thing, because they're also not, they don't charge a commission on those trades and might be accepting that order flow payment. That's why I said I've never seen it. I own all my I own all my accounts. I'm responsible for all my accounts, and I'm responsible, and most BDA members are responsible for their accounts. But I think I can see now where Larry might see that from a different type of brokerage model.
Well, we certainly know that whenever bid-ask spreads are wide, wholesale dealers pay for order flow in the equity markets or in the bond markets. The SEC's been concerned about this issue for ages. And it is the agency problem that keeps the system from changing for the vast majority of retail investors.
Thanks. Another question from Damon Silvers.
Thank you. First, I just want to make a comment that I want to express my gratitude to Commissioner Buwar for sort of sponsoring this conversation. I think this is exactly the sort of thing that this committee ought to be, constantly kind of looking into. So I tip my hat.
Great. I think we just made news here.
I want to come back to something really basic that I think Mr. Noble said earlier in his presentation, and make sure I heard it right and see what Professor Harris thinks of it. I think, Professor Harris, you were talking earlier about how the kind of variables involved in bond trading are actually there aren't that many of them for investment-grade corporate bonds. And my learning in life suggests that really complicated things tend to be more expensive to trade, and really simple things tend to be cheaper in general in life. Mr. Noble, I thought I heard you say in your prepared remarks that when you add in all costs, all trading costs, that the market in corporate bonds in the issuers that Steve was talking about, the couple of hundred relatively liquid issuers, that when you add in all the costs from the perspective of a retail investor, that market that the trading costs are comparable to or lower than those for highly liquid equities. Did I hear you right? And if so, Professor Harris, do you agree?
And I'll just state that before I came here, I did what Larry suggested that any savvy investor do, is I went to my internet page and I pulled the equity commission schedule. And the equity commission schedule is clearly posted on the Wells Fargo Advisors page, and it shows what your equity and options commission schedule would be with no discounting. And most customers have some discounting depending on your customer size. But when you look at what Wells Fargo charges, which we're not a discount shop, and it would be, of course, any stock trading over $1. And I used Apple as a representative because what's interesting about Apple is it was trading, well, before the whole market went down, around $100 a share. So you could transmit it into $100,000 or 1,000 shares of Apple, or 100 bonds of Apple, $100,000. And if you're buying a 10-year Apple bond, you probably have a difference between, par and 101 around. You see a price printed at 101. If I'm making a lot of this up because the coupon may not be at 101, but 101. And the commission for about $100,000 trade would be actually more at a full service house than that same $1,000 commission on the bond. You start to drop down, no question about it. If you're dealing with a $40 stock, it would be in a different price point. But it's fairly similar. But to your point, the commission is disclosed on the confirm, and your client can look up the equity commission on my internet site.
It doesn't really answer my question. What I thought I heard you say was that when you take everything into account, commissions, bid-ask spread, the whole nature of transaction costs, and you're comparing liquid large cap equities to liquid investment grade bonds, that the total transaction costs are comparable or maybe even better for bonds than for stocks. It's not just, but it's not just commissions. I mean, I'm asking the way that an investor would ask, which is the whole.
Well,
thing.
If you're talking about how much does it cost me for you to hold a bond, so to your point, the transaction cost in a bond has to take in effect that I have to pay you the interest, unless you have a dividend-paying stock, which I understand that could be. I'm paying you interest. I'm also have to do continuing disclosure depending on it's a municipal or corporate. I have to inform you of that. So you're talking about the actual transaction cost and then the holding costs? I think I'm missing something.
I'm
sorry.
I don't know. I don't think this is that complicated.
Okay.
I mean, maybe I'm missing something. But my notion of transaction costs in a securities trade is the combination of whatever explicit fee I'm paying the broker, the broker that I'm getting it from, plus whatever built-in cost there is in terms of the broker-dealer's ability to, as Professor Harris I think has described in some detail, the broker-dealer's ability potentially to skim me on a bid-ask spread. And I don't mean to be pejorative about that, but that's basically what it amounts to. Those two things together seem to me to be the transaction costs involved in buying or selling a bond.
Okay.
Do they add up to be more or less for a bond or a stock?
They could be the same. They could be less, depending on the commission you pay on the equity and how much spread is in the bond. So this is part of the problem, not part of the problem, it's part of the issue. There is no commission schedule for bonds. So I could have a bond where the markup, buy it at 99, I sell it to you at par. On 10 bonds, that would be $100. In that $100, I pay the broker and all the other costs involved. On an equity, depending on the equity, you could have the same $100 commission. It could be $98. It could be $9 if you go to a discount, equity shop. So in my shop, they're similar kind of costs. Commissions, fully disclosed, no question about it, and markup, which after trade, you could look at my markup and see where I marked the bond up from.
Can I add a few comments here? First of all, I think we're all very clear that nobody wants to set commission rates or markups. All we want to do is create an environment where people can compete and know what's available to them. We want more transparency. Secondly, we've heard a lot about the cost of putting together a trade. So I presume that Interactive Brokers faces some of those same costs, and yet their commission rates are vastly lower. Okay, so you can trade 100 shares or probably even 1,000 shares of Apple for about $2, and you can trade a bond for $1. So somehow Interactive has to be able to manage those same costs that that Craig was talking about, and we're able to do that probably by we are very efficient. Again, I remind you that I'm a director. It's not my business to sell the thing, but it's an observation that's potentially not my business here to sell Interactive, but it's an observation that I think is relevant to our discussion. You spoke earlier about the complexity of bonds and the difficulty of pricing bonds. And you're absolutely right about this, that bonds are simple if we're only credit and only interest rates. But in fact, many bonds have attached to them various bells and whistles. They have sinking provisions, refunding, puts and calls, and so forth. And this additional structure that's attached to a lot of bonds just does not help investors. And so this committee and other voices could help the investors and the corporations if they told them that they should be issuing simpler bonds. The corporations have this belief that, and it's promoted by the investment banks, that if you attach this particular option or this sinking fund or this or what or that or to the bond right now, you will get the very best rate. Okay, and the trouble is that when you do this, you end up creating a hybrid security. It's really a combination of a straight bond plus all the other stuff, and generally the corporations don't recognize the costs of the other stuff that they hang on to it. And all this does is it creates an environment where Sharpies are able to make more money because they can see through all of this, and individual investors and most institutions can't. And it only increases the need for transparency so that we can figure out what things are actually worth, so that we can actually discover prices. As long as we're talking about price discovery, let me give you one further benefit. As we know, many bonds simply don't trade that often, and yet they're held in portfolios that have to be valued every day because they're in mutual funds. So those valuations often use matrix pricing models because the people who collect information to value those funds aren't aware of the best bid or offer that's available. Now, if they have an equity that isn't traded, they'll look to the bid or offer and typically choose the midpoint or the bid price to value that security. So the mutual funds have a daily need to have current and accurate information about security values that a national best bid or offer in bonds would greatly facilitate. And in addition to ensuring that transactions, the deposits and redemptions in those mutual funds are done at more fair prices, it would also ensure that the managers of those funds don't every now and then exaggerate values when those exaggerations would benefit either their fees or their reputation or something like that. We're all aware of the various frauds that are associated with the difficulty of pricing securities that don't trade very often. So creating more information will be of great benefit to the mutual fund industry as well.
Thanks. We have about 5 minutes left, and we're sort of short on time, but we have some questions remaining here. So let's go with Steve Holmes, then Darcy, and then Roy will have the last word.
This will be a short question for Professor Harris. I applaud your recognition that one size does not fit all, both in the equity market and in the bond market, as you suggest. My question is, your notion of an NBBO for, say, 200 bonds, highly liquid bonds, is that extremely conservative? Could it be extended to 400 or something? It just 200 seems small to me. It's just a question.
I'd certainly be very comfortable extending it beyond 200. We recognize that change is difficult for a lot of people, and as a consequence, there's a huge demand for incrementalism. I think these issues are really obvious. I think that ultimately, I'm not an advocate here. I'm just a messenger of what's going to happen in the future, and it's my hope that if we have the future come to us earlier, that we'll all be better off as a result. So I think that you could just, if I were a king, I would just adopt all the order handling rules that we have fixed in the equity markets and be done with it. But I'm not king, and so we can just ask for as much as we can get.
So is 200 the most that you would start with if you're going incremental, or would you be comfortable with some higher number? And if so, what is that?
I'd certainly be comfortable with a higher number. 500 is a nice round number. 1,000's even nicer. But so is 200.
Oh, sorry.
kind of limit. So I'll be very quick. I think I don't want to speak for a whole subcommittee, but I think the Trading and Market Subcommittee is interested. We've had discussions, and we'll certainly be, working on this and coming back, I think, to the full committee with some suggestions. I, too, was on the MSRB, I think 15 years ago, and we were talking about the same things. So it does strike me that maybe at some point market forces are not sufficient, and the Commission might need to give a little bit of a shove to sort of move progress. I look at what's happened in the swaps market, where they just, the CFTC and now the SEC's, just said, yeah, we got to trade them on exchanges, the liquid ones. That's it. And everybody complained, and everybody, and then now we're doing it. And so it's not a perfect world, but it may be. And I want to, in particular, commend. I know Commissioner Piawar gave our subcommittee a huge amount of stuff, and we sent it around to the full committee. In particular, there's a very shortish piece that just came out in November from the financial economists, which I like because they're economists over 50, so I appreciate that. But in any case, I would commend that to the committee of all the big packet. If you didn't have a chance to get through it, you might want to look at that, because I thought it was really interesting and practical. I just go back to kind of Trivago or Hotels.com or these other new ways of taking lots and lots of things that are for sale and providing information to consumers. I can go on my discount brokerage now and buy Treasury securities this way, and I know exactly what my commission is. And how great would it be if I could go on, and yeah, I can't buy all billion bonds outstanding, but if there are a few hundred issues that are pretty comparable, I could go on and say, gee, I'm looking for a New York tax exempt something or other, A or above, what are my options today? And I could just have, do that in the privacy of my home. How great would that be? Anyway, so I think the subcommittee will come back and would certainly encourage our two commissioners, who I know have both been active on this, to kind of see if we can actually do something this year.
Thank you both for your presentations today. They've been very informative and very helpful. I wanted to focus on you, Mr. Noble, with a question. Hopefully it's not a can of worms. If it is in advance, I apologize. What's in your mind? I appreciate that, particularly given your balance sheet and your business model, that when you take possession of inventory, you're holding real risk, and as a consequence, whether you want to or not, I'm sure your ultimate parent company CFO will charge you some capital charge, and you have to pass that along. But if we narrow the universe to, my guess is you probably take issue with the whole concept of a riskless principal transaction as a consequence, because you in fact feel that charge in your P&L. But so there's risk to you in any event. But Professor Harris points out that there is a not insubstantial, lawyer phrase, not insubstantial universe of transactions that he's been able to identify with, let's say, a 2-second holding period or something less than a minute, and so on and so forth. In your mind, what's the best argument for not disclosing, either in advance or on a post-trade basis, to underlying customers who are trading with you, particularly if you're holding inventory, for not disclosing to them that markup either in advance or afterward, just like you disclose your commission? Again, you're talking about a series of trades where you're holding it for, let's call it less than a minute, less than half a minute. And I don't mean to focus on Wells Fargo at all. We're talking about perhaps a rule that applies to the entire market. What's the best argument against a rule that says if an institutional counterparty to a retail account holds a bond for less than 5 seconds, they ought to explicitly disclose the markup they're imposing relative to their cost basis?
This is where I'm going to go a little off the reservation, because I believe you should. I was one of the people on the MSRB that was looking for post-trade transparency within the marketplace. The problem that we have is, and I think it's been stated a number of times within this room, and I'm a little of an outlier even in the BDA, so this is not the BDA's thought process, not even Wells Fargo's advisors' thought process. I want to make sure everybody understands that. I have been, especially for those trades that are truly riskless principal trades, there should be a disclosure of markup in those transactions. Because to your point, I didn't take a position in that bond, and I didn't have any principal at risk in that bond. And I think that in a large part what we've been talking about, it's getting the establishment to realize that the marketplace has changed and we need to move on. And I've had this conversation with financial advisors because the same conversation about commissions existed when there was a minimum amount of commissions that weren't disclosed, you know, in the spread in the early 60s and 50s and 60s, of what you used to do and what you have to do to make sure your clients understand, especially from a full service broker's position, what they're paying for. So if a client can understand that you're going to charge them, goes back to that $100 on a 10 bond trade that you're going to hold for 10 years, is that the client you want to have? And if you can't willingly disclose that, then what are you trying to hide? Because you're working for that money. Because what I want to make sure is that it isn't where you've picked the bond off the screen and done something on your own, but most of the clients at Wells Fargo Advisors and the BDA are clients that actually call a retail advisor, ask them what's in the marketplace, ask them for their suggestions, want to know what their thought process is, have some kind of advice model that they're giving, and to charge $100, let's just keep going back to that, for $10,000 investment, I don't see why anybody would object to it. I would hope you wouldn't object to it if you saw it disclosed. So I'm outside the BDA and outside Wells Fargo. I think that on those principal transactions you should have, and I think if you look back, if there were records in the MSRB board members, you'd see that I was a firm believer that we should have. And I'm a little disappointed right at the moment, and I've had this conversation before, that we can't harmonize the rules between FINRA and MSRB on what that should be. And we need some help on that.
I guess one last question. Just to finish up, maybe just for both of you, if the commission itself doesn't require something by rule, given how trivial this technology is to basically get the couple hundred most liquid listed somewhere, basically, and you've already got exchanges and all that have the technology. This is not a technology issue. This is nothing other than a willingness to do it and a question of whether or not somebody really cares about the service. Is it the view that without a rule, without government prodding, this simply can't occur? I mean, we certainly have, I always find it fascinating in this space where we can find people who go out there as entrepreneurs and can decide to figure out how to get people to put their homes up and have rooms available for somebody who they don't know to be there for a weekend. I find it amazing that people will go out and do that with their cars, but somehow or the other, something that's so obvious as this, we can't seem to figure out a way for an entrepreneur to go out there and actually do it. So without at least a rule that says it. So either is there a rule that's in the way of getting this done, or is there some conspiracy and collusion in a backfilled room with a lot of cigar smoke that basically everybody says we're not doing it? What's stopping this from just simply happening?
It's neither. It's neither a conspiracy nor a rule. It's that the established system benefits those people who have power, and the people who don't have power
But with all due respect, that's the case everywhere. That's always in every single market.
And that's why.
So I'm trying to figure out what's really different here.
Okay, so here's a quick observation. We adopted the trace system, Emma, 13, 15 years ago, so almost. So 10 years at least. And almost all brokerage systems still don't report last trade prices when you look at a bond. In fact, you generally just can't even look at the bond. And they tell you, you go to a system and say what's available, and they give you a list of what's available. Probably, most likely, or typically, because they're looking at the ATSs or they're looking at their own inventories, but usually it's off the ATSs now. And they're not even showing you the last trade prices. So why aren't they doing that? That's really easy because it's just a feed from Trace. They have the technology to do it, but they've chosen not to do it. Well, it must be that there's not enough demand for it. Customers don't know it well enough. Now, that doesn't mean that we should feed everybody this stuff, but given the obvious agency problems and the overall benefits to the economy of having more transparency, it seems that a little bit of prodding would be useful.
I guess I'd love to have a more philosophical answer as to what actually is the issue, as opposed to just recitation of facts that it hasn't occurred yet.
It goes back to the same premise I said before. You have 5 ATSs, a minimum of 5 ATSs. Who's going to be the winner? Where are you going to funnel it to? It goes back to, why does Uber exist and Lyft exist? Why there are competing systems. I mean, that's what you end up having. And are the two going to merge at some point, or we're going to force everybody who wants to get a ride to use Curb or somebody else? There are a number of different thought processes behind it, and that's where it is. There are electronic marketplaces out there. There just happens to be 5 of them, or 6 of them, or 7 of them. I couldn't even count how many there are. So I don't want to say that it wouldn't take a rule, but we're going to take some kind of thought process about where it's going to go. So you can't just have, is it going to be interactive brokers? Are they going to be the winner? But I mean, where's it going to go? That's the whole thing. And then everybody else is maybe a loser. That's the problem.
So speaking of winners and losers, perhaps
just one observation: why is that a problem as opposed to a solution? That actually sounds like what you would like to have happen. I mean, we like the notion that there's Uber out there, and I like the notion that there's Lyft out there too, because I think it's keeping Uber on their toes. So why would we not want to have that?
Because you said you wanted a central marketplace.
I didn't say that.
I didn't say it. Okay. But I mean,
I want it to be a better marketplace.
Now, to your point, if you, different services do aggregate. I use an aggregation model on Bloomberg. They aggregate all my bid wanted information. They aggregate all the prices out there. I pay them a lot of money for the aggregation. So there are thought processes around there, but it isn't an exchange. It's just an aggregation of what's available in the marketplace.
I'm certainly not advocating a central market by any means. What we're talking about here is just the production of better information so that people can choose their vendors on more information, and so we can see more clearly what the quality of the service being offered is. If I may, I'd like to close on a very quick observation. Dealers are extraordinarily important in the equity markets, and dealers, even in our current electronic equity markets. And they will remain extremely important in the bond markets. There's no question that these changes the dealers will remain important in bond markets because there are just so many issues. So really what is in front of us is what's the structure likely to be. The dealers will accommodate, they'll change, and some models won't work, but new models will emerge. And there will still be people who are willing to buy and sell to provide liquidity to the public when they want to, because there's always going to be a return for doing so, because the market prices will adjust to ensure that there's a return.
Craig and Larry, thank you both very much on behalf of the committee for spending your time with us. It was great information, and we appreciate your time here, so thank you both. Well, we're running a bit behind, but I think we have enough time to get through our next agenda item on time. It is consideration of a draft letter to FASB regarding materiality disclosures. Roy Katzowitz is the chair of the Investor as Owner subcommittee, which is where this emanated. Roy, along with Joe Carcella and Jay Brown, put a lot of time and effort into drafting this. It's a little bit more complicated issue than some of the things that we've been talking about here, and we very much appreciate your time in putting this together. Roy, take it away.
Thanks very much, Kurt. I think credit ought to go where it's due, and particularly here to Joe and Jay, who are the primary draftsmen of the letter. Our subcommittee is offering up to the full IAC for submission to FASB a comment letter that deals with the proposal issued by FASB in late 2015. The exposure draft, as termed by FASB, deals, generally speaking, with the concept of materiality as part of FASB's conceptual disclosure framework for financial reporting, and more particularly for the application of the concept to financial statement footnotes, where a lot of the action is for those of us who are analysts of balance sheets. Before we go too deeply into the specifics of the letter, perhaps I can give at least my own point of view regarding the context here. The context in which this proposal came forward from FASB, much like the SEC's own disclosure enhancement, one could call it, or perhaps one wouldn't want to call it disclosure overload project, it seems to be going on at the same time as FASB's efforts. And FASB put out this concept, and a lot of the supporting literature describes sentiment that there is too much detail, too much immaterial detail in financial statement disclosure, and insufficient opportunities for individual issuers and management teams and auditors to exercise discretion to exclude some of that unnecessary information. It is an interesting premise from which this project emanates, because from an investor perspective, I think there may be just a fundamentally different point of view as to whether or not there is too much disclosure out there. I would posit from an investor perspective that is simply not the case, that indeed disclosure is something that is both the bedrock of our financial markets, the hallmark of the SEC's disclosure system, and actually one of the things that makes our financial markets great, and perhaps, and I would venture to say, the greatest in the world. So, in that vein, the Investors Owner Subcommittee took a look at FASB's exposure drafts, and you have in your materials today a short letter that we are proposing be submitted to FASB with the full endorsement of the IAC. Of course, we're here at the Owner Subcommittee to answer any questions regarding the letter, and I'll just walk you through a few of the elements. So first and foremost, we talk about the conceptual framework, and it's important to understand that the conceptual framework is really a guidance element for FASB itself, and not specific guidance for individual issuers. And there are a number of discrete changes regarding the concept of materiality that FASB has suggested. In suggesting it, FASB has indicated that they view this as a kind of harmonization or removing inconsistencies between existing guidance from the Commission and standard setting by the Office of Chief Accountant and staff. And they've changed a few words, some of which may seem significant on first blush, and maybe less so upon further examination. So in particular, there is the change of the word could to would, and the question is a piece of information, could it be relevant, is the current standard, and the question is, would it be in fact something that have impact on a financial statement user's use of a financial statement taken in light of the mix of full information. And should the change have been only the could to would, my suggestion to you all is that we probably wouldn't have had a comment letter, because indeed that would have been a harmonizing concept, and there doesn't appear to have been any meaningful improvements in disclosure when FASB itself had changed the could standard, and we don't believe necessarily there would be any diminution in the standards and transparency in financial statements if we go to a more narrow would standard. However, there are other changes that are embedded within the phrases that FASB is seeking to change, including, rather than focusing on, as the language specifically sets forward today, the specific aspect of relevance based on the nature of the item that's the subject of disclosure, as well as the information as it relates to the totality of the issuer. And now the standard is going to be focused only on taking the full mix of information of the issuer taken as a whole. That, we believe, is a meaningful change and something that we think is actually a step back. In addition, there's a concept, what I'll call a self-ratcheting concept, such that FASB will now harmonize its definition to the Supreme Court's definition as it currently stands, and as it will change over time. And we think there are sort of two central problems with that. First, having this kind of self-ratchet in a change of standards means comparability period over period if and when the Supreme Court does change its prevailing legal standard for fraud, would be something that would be, sort of embedded inconsistency over time in an accounting standard, which we think is a negative thing. But more importantly, and it's something that we've voiced very full-throated manner in our last public meeting, we don't think that lawyers' analysis should be the touchstone of whether or not something ought to be disclosed, but we prefer the accounting profession have its own standard, and it could be, believe it or not, a higher and better standard than the legal standard, even if it's articulated by the Supreme Court. So that's the first part of the letter. The second part of the letter is actually, in a way, perhaps more impactful, because it fundamentally changes the defaults that currently exists for financial statement footnote disclosure. So currently, U.S. GAAP provides that an element of disclosure need not be addressed by GAAP if it is immaterial. And the exposure draft that FASB has put forward would change that default rule such that there would have to be an affirmative determination that something was in fact material in order for it to have to be disclosed. And that is a very, very fundamental change, and one that has caused us, candidly, great concern. Part of the justification for going to that standard is a very, and I give FASB a lot of credit for this, open interest on the part of FASB and financial statement preparers that there should be greater management discretion as to whether or not something ought to be disclosed in financial statements. On the one hand, that may sound like a good idea at first blush, but we take, we believe that there is serious risk that the natural incentives by issuers and auditors to actually avoid disclosure and come to the conclusion that something is not material may overwhelm the quality and level of transparency in the marketplace. As a consequence, we think that's a really bad idea, and we think that it ought not go forward. And I would say maybe one last element regarding process. I would give FASB enormous credit for engagement with particularly our subcommittee. FASB board members have been made available to us on demand. We've had incredibly open and honest discussions, and I think that they deserve a lot of credit for that. In addition, we understand that sometime in 2016, FASB will hold a roundtable discussion to air out these issues. And I think that's an important lesson, particularly in this issue, but perhaps even going forward. And maybe, despite those compliments, I'll add the criticism that when these exposure drafts were initially put forward, they were put forward on a 30-day comment notice basis, and I think that's a very bad idea. These things are fundamental. Giving people in the marketplace and financial statement users the ability to only comment on this kind of thing on a 30-day basis is just something that we ought to avoid in the future. Luckily, this committee and the help of staff and senior members of the commission were able to catch it in time, and now we have the opportunity to put our voice forward in a more formal way. So at least I, for one, strongly encourage this committee to approve the submission of this letter to FASB. Any questions? Rick?
Okay, so this is one of those complex areas where my learning curve is extremely steep, and so I'm still trying to wrap my head around this a little bit. But I guess, obviously, the letter makes clear we don't like the direction that the FASB's headed. We don't like the proposal. But I guess my question is sort of, implicit in that, are we basically endorsing Con 8 and saying we really like Con 8? Or are we just saying we don't like the new proposal?
That's an excellent question, and I hope for those who have time to read through the full letter that they'll understand that we aren't actually merely endorsing the status quo. What we've asked the FASB to do is to say, listen, if you're going to make a change, we need to better understand the factual or policy predicates that support that change. In our own view, the exposure draft and accompanying commentary simply don't go far enough to explaining why this is a very good idea. And so rather than just rejecting outright and simply endorsing the as-is standard, what we've asked them to do is frankly take a little bit more time, come back, repropose changes should they continue to feel that they're necessary, and provide that factual and policy predicate for those changes, which we think currently is lacking.
Okay. So I think that's important to know, because I think one of the things from FASB's point of view that they're trying to do is resolve what they see as some inconsistency between Con 8, their Con 8, and the SEC's SAB 99. So I guess my next question that I'm wondering about would it be kind of a viable alternative from your point of view or others on the committee, instead of going with this new approach where they basically, throw their hands up in the air and say, whatever the Supreme Court says, that's what materiality is? Would a viable alternative be to go backwards to Con 2, which is consistent with SAB 99?
I'll speak for myself, and I'll let Joe and Jay add. Sure. But they're the ones who are the actors here, right? If they're seeking for change, we need them to lead us in a manner that they think makes sense. We don't think there's consistency in their own support for what they're trying to do here. So that could very well be an approach, and we invite them in the last part of our letters to withdraw the current proposal and proceed with future proposals with a more complete record and predicate that could very well be just that. And I'm sure the FASB folks will be listening to this and might take you up on your suggestion. But I'll ask Joe and Jay if they have anything further they might want to ask.
Did we lose a connection?
I lost sound. Adam did.
Yeah, I can't hear either.
We're working on the microphones. Joe is
Okay.
making some very good points. You just can't hear him.
Sorry. It seemed like it was on.
We trust him.
It seemed like it was on. In the absence of that kind of a framework, I think it's problematic. So that, as Roy talked about, where we talk about the actual change to the codification, we make 2 points. One is to go back to the language which says disclosures are required unless you conclude they're immaterial. Mm-hmm. And our discussion, both with the FASB and with certain people in OCA, I think this was inadvertent. So I don't think they're opposed to that. So I don't think this recommendation, that piece of our recommendation will be particularly controversial.
Right.
The second piece is to work expeditiously on developing a robust framework for evaluating disclosures, not just quantitatively, but qualitatively. So going back to Con 2, if they leave this kind of language in, Rick, may still be a bit dicey.
But something like Con 2, I mean, because Con 2 had a framework in it,
right,
and it addressed some of the issues that we seem to be concerned about. But I don't know the history like you do. I don't know why they moved away from Con 2. I guess they were trying to conform more with what the IASB had when they moved to Con 8. But I don't know why. I don't know the history. I don't know the downside to going back to Con 2, I guess.
Yeah, and again, as Roy, I think, articulated pretty well, the first half of this letter deals with the FASB's own conceptual framework, which really doesn't even affect what issuers are required to do. So that's probably less problematic. The second half of the letter deals with the codification, and that actually affects what issuers are required to do.
Okay. Damon, do you, comments?
I just wanted to speak in support of this effort. This is as Commissioner Stein, I think, alluded to when we convened this morning, this is a very large issue. This aspect of GAAP really is it's the spigot for information for investors broadly about firms, and changing it is a quite significant thing. I think that it's my view that it was never intended that the standard for what is material should be the standard for what the omission of which would constitute fraud. That is there's a very significant space between those two things, and that if you think about it for a moment, this will be, I think, immediately evident. But the real I think wisdom of this letter is what Roy was talking about a few moments ago in response, Rick, to your question, which is that this is huge and hasn't been thought about carefully. It hasn't been thought about by this committee carefully. We haven't been, we've just begun. Not our fault. We've just kind of begun to understand it. It hasn't been in front of the investing public. It hasn't been in front in a serious way of the accounting and auditing profession, or for that matter, a wide range of people with responsibility for this system going up to Congress and the like. The reason why this letter is I think why spot on is that it urges careful thought and in a process in which the full implications of what's being done here becomes clear to all the interested parties, and FASB gets an opportunity to really hear from investors as to what investors think about what they're talking about. This is, again, an example of one of these things where the words kind of sound the same, but they really don't mean the same thing at all. If you look back over the last couple of decades of securities regulation and accounting and auditing, this is precisely the sort of thing that people generally regret profoundly later when it hasn't been processed thoroughly up front. So I urge my colleagues to move this through. I think it's careful, and it's a careful, thoughtful job.
Thank you. Susan's next. Susan Woderko.
Thank you. And I speak with full humility as the new kid on the block and my first meeting, and so please take these comments in that spirit. I had not seen this letter before I got here. I've just had an opportunity to look at it. I agree with Damon that these are very important issues. It's wise to proceed thoughtfully. This letter shows a great deal of work. I have a question to the committee as a whole, which is that as I read the mandate of this committee, it is to advise the Commission on regulatory initiatives and to submit findings and recommendations to the SEC. And I guess I look forward to hearing why this I'm incorrect and this is within the mandate of this committee. It strikes me that it is somewhat outside of the mandate of this committee, and if it were to be so, then I would be concerned that reaching out and doing things outside of the express mandate of the committee might have the unintended consequence of diluting some of the very, very important recommendations this committee will make to the SEC on investor issues.
I think that is an excellent point, and many of us, particularly those with legal background, were leery of doing anything that might be viewed in the Latin as ultra vires. And initially, actually, this letter was in fact addressed to the Commission, urging the Commission to basically submit it to the FASB, perhaps with reference to the IAC. As a matter of efficiency, it was suggested to us that we submit it directly. But more importantly, the FASB in some ways can be viewed as an instrumentality of the SEC insofar as its ability to promulgate rules is essentially one of delegation. So in this regard, we're viewing, at least for this purpose, the FASB as, for lack of a better description, in effect, a subsidiary of the SEC. It's really more of a practical consideration, and I agree with you to urge this committee on a going forward basis to be very careful to not move outside of its mandate.
This is Barb. At some point, can I have a chance to
Go ahead,
comment?
Barb. Go ahead.
So first, on that previous point, that if you look at the legislative language in Dodd-Frank, I think you'll find that our mandate is, in fact, somewhat broader than just commenting to the SEC on its initiatives. It includes commenting to Congress on legislation, which we've done, and includes commenting on the rules of self-regulatory organizations. And I don't think it's a stretch to include FASB in that latter category. So I think this is sort of well within the jurisdiction of the committee for that and for the reasons that Roy just mentioned. I also just wanted to say I strongly support this recommendation. CFA filed comment letter on this issue as well and raised some similar concerns. And beyond just the technical substance of the issue, I think there's a procedural problem with the way this issue has been addressed at FASB that I think our weighing in can help to reform, which is the notion that we're going to improve disclosures without starting from the assumption that we should talk first to the users of disclosures to see in what way they believe those disclosures need to be improved. I think it's a concern in this process that, you know, around this issue of materiality and what issue gets disclosed, which is of enormous importance to investors and other users of financial statements, that there is an assumption that I think is not informed by a lot of conversation with those users of financial incentives, that it's automatically going to be better if we reduce those disclosures. And so I support this proposal both because of the content of the letter, which I think is very well done, and because I think there's a broader issue here about how we address disclosure issues, starting with the concerns of the users of those disclosures, that is valuable for all parties involved in that process. Thank you.
Thanks, Barb. Steve Wallman has a question.
Not a question, but a comment. Is that permitted? I fully support the letter. I think it's great. I think it's a terrific and well done letter. I think it's very thoughtful. I think just on Susan's point, I think we actually did recognize this point. Just don't want there to be any suggestion that it was overlooked. It wasn't, and it was thought through, and we decided that we thought this was within our purview for the reasons already mentioned. I just want to clarify a couple of things, because I think there could be a tone that gets taken away, which is that there's a view that more disclosure is always better, which I don't think is what we're trying to say either. I think we're trying to say the right level of disclosure, and the right disclosure is what we're actually trying to get at. I think sometimes it gets read too much as, you know, we should just reduce disclosure, that'll be better, or we should make sure that there's always more disclosure, that'll be better. I don't think either is a right approach, and I think we ought to be sensitive to the fact that you can fine-tune and do need to fine-tune disclosure because the world's not static and it continues to change, and we should make sure that the rules can be updated as well. I think the way FASB did this is obviously flawed in a number of different respects, as pointed out by others already who have spoken, and also in the letter itself. I think it's a real problem to not have recognized the very significant change that this was otherwise suggesting, and to the extent that some of what was supposedly suggested was actually mistakenly suggested or not well thought through. That, I think, is unfortunate and very sad, because I don't think that's the way any regulatory agency really ought to act. And I think that that probably is sort of one of the biggest lessons, not just on the substance, but on the process as well. This is something that when you get to this kind of substance, and we say it in here that we encourage FASB to be mindful of how it actually is approaching kinds of changes like this, or suggested changes like this, that it actually be thoughtful as to how it really does it, because I think this was not good. But I don't think there should be a suggestion that anytime there's a rule that requires disclosure, that somehow there's a ratchet that's never going to be rescinded. Because I think if you do that, you get very unintended consequences the other way, which is every rule then gets hard fought, even if it's obviously a good thing, because people are afraid then that it will never come back out. Obviously, that doesn't make sense either, and we should be cognizant of the fact that this does have to be an evolution. I think the only other thing that I'd like to point out is I do actually think this process that FASB went through of a conceptual framework of how they approach actual rules that then are promulgated, which are then what the issuer community needs to comply with, is actually quite a good one. You know, if the Commission actually had a conceptual framework for the securities laws and how it approached rules that were just going to go out, that actually might be a very helpful thing to consider. And I think sometimes people think that there is not a great deal of conceptual framework for the securities laws themselves, other than what's in the statute. I think although we're hitting pretty hard at FASB, and I just took my own little swipes, I think they should be commended for the notion that as a conceptual matter, the idea of having a framework is actually really quite good. Whether in this case we agree with what that framework is purported to be or proposed to be and how it was supposed to be amended. But I do think that there are some really good things here, and I think FASB should be commended for an awful lot of what they've done and for the hard work that they normally put in as we continue to bash them. So, thanks.
Thank you, Steve. Are there any other questions or comments? Jay, did you? Okay, anybody else on the phone? Any questions or comments? Rick Fleming.
And it's a question for Damon, because your comment about essentially what we have, we get the definition for materiality out of an anti-fraud case, and it was imposed in an anti-fraud context. And so the question is, do we really want that to be the standard for what's required to be disclosed within the accounting context? And you made that point at our last meeting, and that's really, I've spent a lot of time pondering that. The one, I guess, thing that differentiates materiality in these different contexts would be the scienter requirements for the various types of actions that we could bring. And I guess I'd like your reaction to how far does that get you in terms of being able to differentiate, bad behavior, and does that help us, even though materiality, the definition would be the same, it's actually applied differently in different contexts?
Was it? No, there we go. All right. Thanks, Rick. All right, so the scienter requirement is different than the materiality requirement, right? And it goes to the state of mind of an actor in a fraud scheme. In the accounting, in the disclosure context, the scienter doesn't come into it, right? What I see in the language that FASB is seeking to adopt here is moving from moving from language that appears to be broader in its scope, right, than the language that defines materiality, right, in the anti-fraud context, to language that is exactly the same. And the question of exactly what that means, right, in terms of narrowing what is required of issuers, I think is unclear. The one thing that I think is clear, is stated in our letter, is that is where the burden falls, right? That you go from that by doing that you go from a standard in which the default is disclosure if it's not immaterial, to one where the default is non-disclosure unless it is material, and that is not a good thing to do from an investor perspective. I think that it's also the case that that if you think about it for a moment, that you want that when an issuer is preparing a financial statement and the outside auditor is reviewing it, that if the standard that from a sort of common sense perspective, the standard that they are applying should not be the standard of, if we omit this, is this securities fraud, but rather a standard about essentially what the sorts of information an investor would want to see in order to make the financial statement, what's the phrase in the letter that the auditors issue? Fairly presented, right? That these are sort of instinctively should be different standards. And I don't think the fact that Scienter comes into play to prove fraud really is that relevant to the notion that those things ought to be different. I think Roy, when he was extolling the greatness of our system, is onto something here, that I think this language is part of a structure that underpins the idea that while we are not requiring issuers to make every piece of information available, and this is Steve's point, and there certainly is such a thing as over-disclosure, that we have had a system in modern times that seeks to make a lot of information available, right? And information which in which we err a bit on the side of disclosure as opposed to on the side of silence. This feels like we're moving. This feels like, without barring a more extensive examination of what exactly this language means, this feels like we are moving toward a system where the default is silence, and that, I think, can't be right. That can't be what anybody really needs.
Jay? Yeah, also sort of in response to that, I just want to say this. Here is the current definition. The current definition is information is material if omitting or misstating it could influence decisions that users make on the basis of the financial information of a specific reporting entity. It's very elegant. It's about users, not just resource providers. You know, the government is a user. Consumers are users. You know, users are a broad category of people. It's what would influence a user in looking at the financial statements. Financial statements, you know, we know from our XBRL days, they're 25,000 tags in putting financial statements together is an inherently complicated document. You know, in our two materiality cases at the Supreme Court, BASIC was a press release, right? It's probably 100 words, you know, or something like that, trying to parse materiality in 100 words, not 25,000 tags, right? This is a very elegant definition. Now, what the proposal is to change it to, if there's a substantial likelihood that the or misstated item would have been viewed by a reasonable resource provider as having significantly altered the total mix of information. You know, that's a brutal definition. It's significant, you know, it's total mix. It's got all of these different terms in there. Now, that has to be paired with the fact that when there is a statement in the footnote, in the second document that says, why is the board issuing this amendment? Why are they doing it? It says, one of the reasons is it says the results of the 2013 Disclosure Framework Field Study conducted by the FASB staff indicated that additional explanation about how to appropriately consider materiality in deciding which information to provide in the notes could be effective in reducing or eliminating irrelevant disclosure. So why are they changing the definition? To reduce disclosure. And so, and I think anyone who reads those two definitions, yeah, thank you. Anyone who reads those two definitions can tell they're very different. The second definition is likely to allow for the omission of more information, for better or for worse, but that's likely to happen, and that's the purpose of this definition. So, you know, whether the first definition is truly BASIC versus Levinson or TSC Industries versus Northway, or it's a better framework for analyzing disclosure in a document that has 25,000 tags, or whether it's the same or a little bit different, it works. And it's a very elegant definition that accountants and issuers apply in deciding what's going in, what's important to users of financial statements. And this is a very significant change in language that's really not fully explained, and it's designed to reduce disclosure. So, you know, what is the right answer, you know, about what should the standard be? I don't know, but as Steve Wallman said, that's a very significant change with a very specific goal in a context that doesn't look like users were significantly consulted.
Hello, Kurt.
Oh, sorry, go ahead.
Kurt, this is Roger.
Hi, Roger.
You know, we certainly had very articulate and thoughtful commentaries from Damon and Roy, and the work of the committee. And I have to say, Jay kind of nailed it for me when he said, "Who is this for?" I think we're talking about investors. Investors need this kind of clear information and access and understanding. I see this proposal as more of a convenience for the auditors and the companies. And that might sound very cruel, but I don't like the direction it's heading. And I would move approval of this letter. I'll make the motion to approve this letter.
Second.
Yeah. We have a motion's been approved and seconded. Is there any other questions, comments? Hearing none. All those in favor say aye. Any opposed?
Aye. Aye.
I do want to abstain on this one, Kurt.
Any else? Any other abstentions? Susan? The motion passes. The letter stands as drafted. Thank you very much again for your work on this. We are now moving into our lunchtime session. We will reconvene here at, let me just make sure I give you the right information. We'll be back here at 1:45 today. Thanks. Okay, ladies and gentlemen, we are back online. Sorry for the delay in returning. Our conversations over the noon hour ran a little bit longer than anticipated, but we'll get right at it here this afternoon. We're going to skip to the 2 p.m. session, an update on the crowdfunding rules. As you probably remember, back in October of 2015, the SEC adopted the final crowdfunding rules that are now in effect to permit companies to offer and sell securities through that crowdfunding mechanism. As I mentioned earlier, the IAC had its recommendation on this back in April of 2014, so almost 2 years ago now, for consideration as part of that rulemaking. The new rules and the amendments are designed to assist the smaller companies, smaller issuers with capital formation while providing investors with adequate protections, and that's specifically what Chair White mentioned both this morning and previously, that was the balance that they were trying to strike, providing smaller firms innovative ways to raise capital while all the while giving investors the protections that they need in this process. The rule does four main things. First of all, individuals can invest in the crowdfunding transactions subject to certain maximizations. The seller is limited annually on how much they can raise. That's number two. Number three, the rules impose some pretty key disclosure obligations on the seller about the business, the nature of the securities, the purpose of the raise, and so forth. And importantly, I think, as any of these, the regulatory framework for the intermediaries who are broker-dealers, funding portals that facilitate the transactions that we're talking about here. The organization that I work for, the CFA Institute, the Chartered Financial Analyst people, were hoping for a big red letter Surgeon General's type warning on these securities that they could be hazardous to your financial health. The rules didn't go quite that far, but there's certainly been some progress on the investor protection front. Our panel today will give us the latest on the rules, what they think about them, how they're going to work, and so forth. And really, I think, interestingly for this group, what remains a challenge with respect to investor protection with respect to these rules. Chris Terrell is here from the Crowdfunding Intermediary Regulatory Advocates. It's a not-for-profit organization here in Washington formed by the industry's leading platforms and experts in crowdfunding to advance its views on intermediary standards and best practices. Judith Shaw is here with us from the North American Securities Administrators Association, NASA, and is the lead securities regulator, the protector of investors up in the state of Maine. And we're very glad to have you with us here as well. We expect that state regulators are going to be sort of on the front lines as a lot of these things happen, and investors have issues with these, so we're interested in your remarks about that. And then finally, Sarah Hanks is here, the co-founder of CrowdCheck, which serves investors and crowdfunders, consulting on the rules and the disclosures that are necessary so investors get the right information and crowdfunders themselves avoid the rules mistakes that's going to get them into trouble. She has a great background as a securities lawyer, and very interestingly, she was the general counsel to the congressional committee that was overseeing the TARP program, the Troubled Asset Relief program. I hope there's no connection here. There will be no bailouts for investors in this activity, I suspect. So anyway,
Damon wouldn't permit it.
So thank you all three for being here. We'll start, just go from left to right. Why don't you start, Chris?
Sure. Thank you, everyone. Thank you for having me. In addition to my role serving the industry as chair of CIFRA, I don't even try to say the whole name anymore. As chair of CIFRA, I also am CEO of OfferBoard, which is a platform that offers securities under Title II of the Jobs Act and its affiliate broker-dealer, OfferBoard Securities. Whatever FINRA disclaimers I need to add them here. So thank you for inviting me to present. Thank you for your continued interest in crowdfunding and your comments on crowdfunding. And thank you in particular for focusing this dialogue, this conversation on looking forward, on not focusing on policy battles won and lost as we got to this point, but in focusing on where we're going. I think that we will be successful at creating a healthy and vibrant crowdfunded securities industry if we're proactive in addressing concerns related to investor protection and related to market efficiency. And I hope that that's part of what this dialogue is about, and I look forward to that. Well, as you're all undoubtedly aware, on May 16th, we're going to, if everything goes as planned, we're going to launch a new piece of the securities industry. We're going to start issuing crowdfunded securities for the first time, a new category of exempt security created by the Jobs Act. Just to give a little bit of context about where I think we are based on the information that I have, we're waiting for the SEC to finalize FINRA's rules for funding portals. The date on that approval was extended to January 26th, so we're hoping that by January 26th, the SEC will finalize FINRA's rules for funding portals so that concurrently on January 29th, funding portals and can apply with both the SEC and FINRA to begin operating as of the date that the laws go into effect for operational purposes on May 16th. After that, the market will launch on May 16th. Sometime between January 29th and May 16th, FINRA will approve whichever portals are going to be approved. Broker-dealers will go through the process of getting ready to operate under Title III of the Jobs Act, and on May 16th, that will all be operable and the market will begin. As you also probably know, we've been in industry and waiting for quite some time. There were many people who thought that congressional action would occur, that SEC action would occur on the date in the original bill, and that we would have had these laws on or before December 31st of 2012. But we didn't. But that doesn't mean that we've been an idle industry. Over the past 3 years, the industry has developed technologies, platforms, and companies, often in connection with other exempt offerings, some of them under the Jobs Act, that include companies, platforms, and technologies focused on anti-fraud functions, focused on investor verification, focused on transaction processing functions. focused on investor education and outreach and technologies devoted to improving that, focused on issuer education and outreach, focused on accounting services that increase the efficiency in terms of cost of delivering accounting necessary for these securities offerings without sacrificing accuracy, and even education systems for educating professionals who are going to be involved in the crowdfunding industry after it launches. CIFRA itself, which I am pleased to serve as chair of, has also developed best practices documents and educational materials for portal operators. The movement itself is truly the definition of a citizen movement. It truly is the best representation I've ever seen of the adage that no change was ever made except through a small group of dedicated individuals. And it's the broadest movement that I've ever been involved with. Democrats, Republicans, conservatives, liberals, people with lots of experience in the securities industry, people with very little experience in the securities industry. And yet the entire industry is dedicated to some real core principles. And I think those shared principles include economic development and job creation as a priority. They include entrepreneurial innovation as a means to an objective, and they include fairness towards investors, fairness towards those that are trying to raise capital, and fairness towards the intermediaries that are trying to facilitate that. But at its core, in the middle of those principles, the industry realizes that investor protection is in its economic best interest, and it wants to innovate to improve the market's fairness and cost effectiveness. Let me go a little deeper on each of those points, and then I'll close. The industry realizes that investor protection is in its economic best interest. If the first stories coming out of the brand new crowdfunded securities industry are stories of loss and woe, as Mr. Holmes put it, of people crying, then the industry will not succeed. Protecting investors is at the core of the economic development of the industry. We share the Investor Advisory Committee's goals of a fair and cost-effective marketplace to ensure crowdfunding's viability as a small company capital formation tool. At its core, the industry also wants to innovate to improve the market's fairness and its cost effectiveness. And I think in the final rules, the SEC has tried to give the industry adequate room to do that innovation. Oftentimes it did so by refusing to give a prescriptive solution to particular issues related to investor protection and operational effectiveness, and instead laying out guidelines and principles that would need to be addressed by market participants as the market was initiated. Such as, for example, the way in which they addressed advertising risk and integration. In many quarters, including this committee, the recommendation was to not permit integration because of the complexities of coordinating the two different advertising regimes that might exist, for example, between a Title III offering and a generally advertised private placement. Instead, the SEC laid out arguments for why it might be difficult to do those two things and expected industry participants to help to solve that and to operate in ways that were in line with those principles and guidelines. They also did it with the way they addressed intermediary obligations with respect to individual investment limits. Rather than a prescriptive way of the industry organizing itself in order to facilitate its verification that investors weren't exceeding their limits when they invested in crowdfunded securities, it laid out guidelines and principles for that and expected the industry to figure it out. Leaving room for innovation is really important. room for innovation allows the market itself to create solutions to problems, which is often more efficient and effective than prescriptive solutions. It lets the operators in the marketplace attempt to find the best balance of cost effectiveness and investor protection within the guidelines established by the SEC and FINRA. To that end, I want to thank the Investor Advisory Committee for its recommendation that crowdfunding portals be given greater latitude with respect to curation of offerings on portals, which serves both a market efficiency and effectiveness role and an investor protection one. At its core, the industry and the Investor Advisory Committee are aligned that investor protection is an essential feature of an effective crowdfunded marketplace. I look forward to the dialogue that will follow these opening statements, and again, I thank you for inviting me to present.
Good afternoon. I want to thank you for the opportunity to speak with you here today. I know the topic is crowdfunding as applies through the SEC rules, but I'd like to talk to you about the innovation that's happened at the state level and share with you the lessons that I think the states have learned that might then be brought to bear with federal crowdfunding. When we look at the history of development of small business capital formation in the states, what we see is that states after the Jobs Act identified a need and an opportunity not only to help facilitate responsible capital formation in a way that honors investor protection, but also to connect with our local small businesses and entrepreneurs and guide them through the myriad of capital raising options available. Raising capital for most businesses is a progression, especially small businesses and startup early stage entrepreneurs. And so in Maine, for example, we have been working closely with state and regional organizations like our New England Small Business Administration and the Maine Center for Entrepreneurial Development to help businesses discern their capital formation path. One stop along that path might be state-based crowdfunding, and I think that perhaps sharing some of the lessons learned in this area from the states that have adopted state-based crowdfunding might help inform further conversations along the road. To just give you a little bit of background, as of this month, 29 states plus the District of Columbia have adopted or are finalizing rulemaking implementing crowdfunding exemptions. I have been asked as president of NASA by some of my colleagues, should we bother moving forward for those states that have not adopted something? And my answer is, by all means, take a look at whether or not this is some state-based crowdfunding is something that can be beneficial to capital formation in your own state, because I believe that the states and the federal approach can complement one another. In addition, 12 additional states are actively considering crowdfunding exemptions at this time, including California, Connecticut, and Ohio, among others. As I'm sure the committee knows, all but one state has their crowdfunding based upon the Section 3A11 qualifying under Section 3A11, the federal interstate offering exemption, and its safe harbor under Rule 147. The outlier is my fine great state of Maine, which based its crowdfunding exemption on the federal exemption in Rule 504 of Regulation D. Mississippi and Vermont duly offer intrastate crowdfunding as well as interstate crowdfunding under Rule 504. There are a number of other states that are considering that dual option approach, and there are some states who are looking at a regionalized approach to a 504 crowdfunding opportunity. I think that what I would like to share with you is after the Jobs Act, the exemptions that we see at the state level, as I already mentioned, tie either to the intrastate offering exemption or the Rule 504 Reg D exemption. Unlike some crowdfunding opportunities, there were 3 that existed prior to the Jobs Act: Kansas, Georgia, and Idaho. At that time, issuers and investors had to be solely in-state. Internet-based offerings were not necessarily allowed. Post-Jobs Act exemptions, internet-based offerings are allowed, and in fact in some states are mandated. Offering caps exist in the range of $100,000 to $5 million per year. Investment limits for individual investors in the state-based crowdfunding range from $100 to $100,000. There are notice filings, including short-form disclosure documents. The main-based crowdfunding includes a short-form disclosure document. Unlike prior to the Jobs Act, where there was no compensation allowed for intermediaries unless they were registered as broker-dealers, in some jurisdictions, compensation of internet platforms is permitted. Those would be considered intrastate broker-dealers, and there are notice filings that are allowed. Bad actor disqualification exists, and in some states, short quarterly reports are allowed to investors. I mention all this because I think that it can highlight some of the important investor protections that the states have found necessary. And I would say one of the key investor protections is limitation on the amount that an investor can invest. When we in Maine, in conjunction with our administration and legislature, looked at whether or not to adopt state-based crowdfunding, we looked at the demographics of our little state of 1.3 million people. We are the oldest state in the country. A large percentage of people in Maine live just above the federal poverty level. The majority of our elderly live on Social Security alone. And so for us to adopt a state-based crowdfunding that had an investor limitation of $100,000, in my view, would not have been responsible. So our limitation is $5,000. For a great number of people in Maine, including my own mother, a limitation of $5,000 is nearly 3 months' income. So for us to adopt a limitation that would allow your average retail Maine resident to invest much more than $5,000 at that point in time did not seem to be a responsible move, and so we viewed that as one of our key investor protections. It's also very important to have the education of the investors and to have, equally important in my view, education of the issuers. What we have found is that crowdfunding, in fact, any form of capital formation, is not right for every single business. That's why we have multiple options. As I said, capital formation is a progression. You know, as a friend of mine in Maine says, you start with family, friends, and fools, and you move on from there. And so it is a progression. What we have found with some of the individuals, the entrepreneurs who have approached us in the state of Maine, is it has ranged. We've had very talented young college students come in and say, I have this great idea, I know it's going to rock, I want to put it together. And we say, great. Tell me a little bit about your business plan. They said, business what? And so that's why connecting with other organizations is important, because what we were able to do after speaking with them for a little bit and convincing them that the concept that they drafted after a night at the frat was not really, could not truly be valued at $2.8 million. We were able to connect them with other local resources that were available so that they could learn what is a business plan. They could start that progression, because they truly weren't even at the family, friend, and fool's point. It's a wonderful opportunity for the states to do that, but it impressed upon me the importance of education for the issuers as well. So I was very glad to hear Chris talk about education for the issuers and the entrepreneurs. They need to understand where they truly are at with their business and not just say, crowdfunding is the next great thing, it's what everybody's talking about, and therefore it must be right for me, because it isn't. I've had a number of conversations with people about fraud. And what they always say to me is, none of the states have seen fraud with any of these crowdfunding offerings. And what I say is, it is not necessarily the legitimate business that we're concerned about. It's the copycats. You can spend 5 minutes on Craigslist, and I can guarantee you, you will pull off at least 5 scams. So it's the copycats that we need to be mindful of and aware of, and make sure that we're on our toes to identify those. Does that mean that we are not going to see any fraud in the crowdfunding space? No, I think that we will see it. The other thing that the individuals, the entrepreneurs who come to talk to me don't necessarily understand, because they come before they've conferred with smart attorneys like Sarah, is, what do you mean I've got to disclose all those risks? Nobody's going to invest in me if I have to disclose that. So again, we're getting back to education. I'm not going to talk about the gentleman who hasn't gotten out of prison yet who wanted information on our crowdfunding law. So we really need to be aware. We really need to educate people, and we need to make sure that we understand that crowdfunding is not the end-all, be-all for every single business opportunity that crosses somebody's doorstep. It is but one opportunity that exists within a whole range of opportunities. Now, if you were to say to me, have you actually completed a crowdfunding offering in the state of Maine, the answer is going to be no. And one of the reasons is because the two entities that really could have benefited from crowdfunding, when we spent some time talking to them, we found that they were actually much better off using our limited private offering exemption, given what they were trying to do at that point. My guess is they will come back at some point in time as they have grown a little bit and matured a little bit for some subsequent offering and possibly look at our crowdfunding offering. It really is a matter of making sure that the business is taking advantage of the right opportunities, that they're educated, that they're getting the advice that they need. I view crowdfunding as high risk for our entrepreneurs, as well as high risk for our investors as well. I think there are great opportunities out there. I appreciate the fact that we are all still talking about it, collaborating, working together, and trying to make sure that we can help support entrepreneurs. But I also really feel that it's important that the risks inherent in a startup business are made perfectly clear to investors, because at the end of the day, in local communities, this type of investing is the purest form of emotional investing that exists, and so it's very important that people understand the risks. I really thank you for the opportunity to chat with you, and look forward to answering any questions you may have.
Okay, thank you very much for having me. Very happy to talk to this committee about the crowdfunding rules and maybe give some idea of how it might work in practice. As we talked about earlier, CrowdCheck is a company that provides compliance for all aspects of online capital formation. So we've been active for the last couple of years in the new generally solicited private placements under Rule 506C, and most recently in the last few months, Regulation A offerings. And so we've had a fairly good experience with just how challenging it is to run a small company and get all of the paperwork in order. And I've got to say, as a small company myself, I don't think CrowdCheck would pass a CrowdCheck review. So I do really sympathize with small companies and the challenges that they have. I have a few themes with respect to the way the rules are going to work. Number one, they will work. These rules will work. For all the criticism that there's been out there, they are going to be fine. Secondly, we should expect a relatively slow start. This is not going to be the next thing. It's going to start very slowly. Thirdly, there is a complete need for investor education. And finally, there is a need even more than, and I think Judith picked this up, even more than educating the investors, the issuers themselves need to be educated, mentored, and protected. So on the theme of the rules working, the rules themselves, they're not intuitive. Nobody is going to manage to do these offerings without some form of assistance. I thought the SEC did a very good job in trying to put together a question and answer format for filling in the Form C. But unless you are a person who understands what beneficial ownership is just by reading the rules, you're not going to be able to file a Form C on your own. However, with professional assistance, small companies are going to be able to comply with the rules. Speaking as a lawyer, I looked at this and we were trying to make the filing with the SEC a lawyer-free process. Can't do it. Can't always get rid of the lawyers. After all, this is a highly regulated enterprise selling securities, and this is selling securities to strangers over the internet. So you've got a lot of potential conflicts there. You've also got the issue that the natural optimism of entrepreneurs needs to be guided and kept in check so that they're not over-promising. But we can make this process a lawyer-light type process. Can't make it accountant-free either. The rules require US GAAP, accrual accounting, which means that for small enterprises who are keeping their books on a cash basis using QuickBooks, which I do, and at the end of every month I spend hours taking QuickBooks trying to squish it into something on a spreadsheet that looks something close to US GAAP. That's a challenge. You can't do that without some kind of accounting experience. So you do need to have guidance. However, when you look at what these rules are going to cost in terms of professional fees, I'm estimating that professional fees are going to be something like $7,000 for a startup company. If you're raising $200,000 through crowdfunding, that is not a bad number. If you're raising $100,000 or less, however, it might be a bit problematic when you add professional fees together with platform fees. One of the things I think might be more appropriate for companies who are looking to raise $100,000 would be to look into intrastate, as Judith mentioned. That might be more appropriate. I also note that there is at least one congressional draft bill out there talking about micro exemptions for offerings under $100,000, and also that the American Bar Association comment letter on the crowdfunding rules recommended that there be a micro exemption for offerings under $100,000, which didn't come with all of these requirements. So that's the workability of the rules. As far as how this is going to work out, we should expect a slow start, as I said. All of the online capital formation rules that were introduced by the Jobs Act have developed slowly. Rule 506C, everybody thought, now, yes, everybody's going to be able to advertise. Hedge funds advertising all over the place. Well, you know, a few hedge funds have publicly sponsored polo matches or yacht races, but we have not seen a lot of small companies doing a lot of advertising because they do not have a lot of money. So that tends not to have happened a lot. But there is a vibrant and growing market for online offerings by small companies, selling only to accredited investors. Looking at numbers, when we look at how crowdfunding has developed in Europe, I think, and especially taking our lesson from the UK, where you have an investing approach to life, when you're looking at those, we're talking about maybe a few hundred companies a year using crowdfunding on that side of the Atlantic, and I don't think we should expect that many more. I've run numbers on the back of an envelope a few times. I don't see that we get much beyond 800 companies a year on the equity side for quite some time. It's not going to be thousands. I think we should pay attention to the fact that this is not equity crowdfunding. This is securities crowdfunding. So there is the option to do debt crowdfunding. I think that will start off fairly slowly, but it will take off when people realize it works. And it may be an option to bank lending. There may be an option there to do royalty. There may be an option there to do trade financing. There is an approach in the United Kingdom where a bank that turns down a small startup applying for a loan is supposed to send them off to a crowdfunding platform. So we might see that working for small companies looking for debt raises. I think we have to be sensitive to the fact there that there's the possibility of the problem of adverse selection. You've been dinged by a bank, so now you go to the public. That is something that we're going to have to take account of. But when you look at why so many companies get refused by banks, a lot of it is because the company has not been in business long enough. So there is a natural market there for if you're too early for a bank loan, you might think about debt crowdfunding. The other thing, when we look at the separate asset class of real estate, which so far has been a big standout in the Rule 506C market, that's going to be very limited in regulation crowdfunding because of the $1 million limitation per issuer. And that, of course, is defined to include projects under common control. So a sponsor is not going to be able to do more than one $1 million project a year. I want to make the point, though, that just because there's probably going to be a slow start does not mean either that the rules are wrong, because I think the rules are fine, or that there was no need for the rules, because these rules are going to help small companies raise funds. Talking about the need for investor education, Kurt had mentioned the fact that you all wanted a great big red flashing legend. I would love to see that. I would love to see a legend on every single platform saying there is no such thing as the next Facebook, and your chances of making billions from your tiny, tiny little investment is zilch, or something like that. You can put it in more formal language, but this is what people really do have to understand. There is no next Facebook. Only Facebook is Facebook. People should understand this legend, which is if you invest, it's because you believe in this idea or these people behind the idea, this team, and you want to give them a chance. Because your friends, family, or I think the final F is not fools but fans. There is a role for people who think that an enterprise is good. If you like the muffins of your local bakery, you might want to help them expand. If you are a fan of a zombie comic book author, you might want to help him raise funds to expand his reach. There is a true role for people to be able to be brought into the success of an enterprise. So they have to understand there is no next Facebook. People have to understand how companies grow. An investor really does have to understand that common shares are different than preferred. And if you have common shares, preferred shares are preferred. They get preference in terms of liquidation. They get preference in terms of anti-dilution protection. Investors have to understand what dilution is. If you invest now and you get 5% of a company, what happens if the company goes and raises more funds? You own less of the company. You are not always going to own 5% of your next Facebook. Investors need to understand how down rounds work. And that leads to the next point that they totally need to understand is valuation. Working in the Regulation A space at the moment, I don't know if anybody's looked at some of the offerings that have been filed with the SEC. There's some very interesting valuations there. You've just had a brilliant idea and you are going to put a company together. The company's been formed three weeks maybe, and you think that your idea is worth $300,000. Maybe not. So investors are going to have to understand what valuation is and how it can change in the future. And that applies not just to Regulation A, but it very much applies to Regulation CF funding, because people are going to go out there and say, hey, you can get 10% of my company for $100,000, which means that the thing is worth $1 million, and they're going to have to justify that. There's also the possibility of down rounds in the future as companies, some companies, not all companies are going to move from crowdfunding to any other form of finance, but some of them may move to venture capital financing, and there is always the possibility of down rounds as professionals value a company at a lower rate than their family, friends, and fans do. And then the final thing that I think we all have to focus on is the need for issuer mentoring and protection. In some ways, I worry more about the issuers in crowdfunding than I do about the investors. When the rules were adopted, Commissioner Pivovar mentioned the fact that there's a lot of footfalls in these rules. And so it's going to be very important that companies know what their obligations are, both in the initial filing and on the ongoing requirement that they file. The exemption from full registration under the 34 Act is conditional upon filing, and small companies fail to file things all the time. Companies also need to understand that they are selling securities, that they are selling an interest in their company. Those people are now shareholders, and you have to treat them with respect and give them information. And then we also have to look at the natural optimism of entrepreneurs. Entrepreneurs really always think that everything is going to work out fine, and they will not hesitate to say it. So sometimes we end up having to tone down things. Don't make promises that you aren't going to be able to keep. Don't say things that you can't back up. And the investors also, the issuers also have to understand what they, not just what they can say, but where they can say it. When you can use social media, you can use social media, but its content is very, very limited. And how the crowdfunding rules under regulation crowdfunding are different than the communications rules under Rule 506 and Regulation A. So very pleased to see Regulation A, Regulation D, Regulation CF all being used to expand companies' reach, and look forward to that happening further. And thank you again for inviting me.
Thank all three of you very much. That was excellent. Let me just sort of kick it off with a question. I know, as Chris mentioned, this sort of, you know, the stakeholders here are across political lines, experience lines, and you know, I think we're still concerned with and caught up in the notion that on those experience lines, and you said even people with very little experience, the two players in this drama, the sellers and the investors, are the ones with the least amount of experience, and it's sort of all, the experience deficit really sort of resides on that end of the range, which I think is still of a concern to us. And I think one of the things that all three of you have mentioned as one of the solutions for possible helps here is investor literacy, financial literacy, and we've talked about that here in the context of highly regulated products and very developed and sophisticated markets, and how weak financial literacy is in general. And maybe it's less of an issue when it's a highly regulated market, but it's still the same dynamic. Financial literacy in this type of product would be even probably weaker. And so any particular ideas in terms of how you improve financial literacy in the context of these type of products?
So I think that one of the things we can do, we have lots of information for investors on how to work with their financial professionals to develop a good portfolio. What we don't have is perhaps as robust education on what is a startup business, how does a business grow, what does it mean to be a shareholder, because in this context they're going to be making these investments not as something necessarily, there's a much more personal touch with this, as Sarah was saying. They truly are the fans. When I look at the list of entrepreneurs that have done crowdfunding at the state level, we're talking about microbreweries and dog groomers and ice cream makers and the like. They really are our neighbors and friends that we are fans of, that we want to support. As I said, it tends to be a little bit of an emotional investment. The investors are saying, I want to support Susie down the street. I remember she went to school with my son. That makes them a little more blind to the element of risk inherent in any startup business. So I would say as much information as we can get out there for investors on what it means to be a shareholder, what the difference is between preferred and common stock, but also the risk inherent in a startup. In Maine, our legislature required the disclosure document that we use for our state-based crowdfunding to have on the front page and on the subscription agreement essentially a disclaimer that says many new startup businesses fail. If you invest, you need to be prepared to lose all of your money. We did have one filer remove it, but it went back.
There's one thing that I've noticed is that there's been some of the people that we are funding through this this method are actually operating as educators themselves. So we're seeing gamification of investment attitudes. I know of at least one enterprise which is a game in which you are able to invest in pretend crowdfunding. And only if you manage to work out the difference between common and preferred shares do you get to win the game. And I am not a gamer myself. People keep trying to convince me that this is how millennials operate all the time. They lose weight through gamification, they save money through gamification. But there's a lot of different ways that you can look at it. It's not just a matter of, here, read this. It says you can lose all your money. You can actually do something a little bit more elaborate and innovative using technology, and fairly cheap technology at that.
And some of the technology is actually getting a lot more sophisticated, particularly in delivering investors information after they've invested, which is one of the biggest gaps in investor information, is getting information from companies once the check's been cashed. And there's a company now that was updating base borrowing certificates for banks using a technology for small businesses that just linked directly to their QuickBooks or 16 other small business accounting packages, and it was a one press button to update it. They've now deployed an entire dashboard that companies that have crowdfunded can deploy so that they can update all their investors with a press of a button, and they can provide them with trending on the performance of the company. So yes, there's a lot of education to be done in interpreting those, but green trend lines and red trend lines can be educational in themselves. I also think that a lot of the ecosystems that have been developing effectively since the advent of social media to create communities of investors have now started to attract universities and local economic development councils and other groups that are interested in investor education. And there are hundreds of programs springing up across the United States for effectively being a beginning angel investor, and how do you get into startup investing and the investing community. And I think those are going to continue to grow and expand as the availability of small securities itself expands.
Chris, would you expect any of these portals or platforms to have sort of a primer, as maybe not as an entry requirement, but something as part of the platform that goes through the basic training?
Oh, I think they're already doing it, and they're selling with it. They're trying to get web traffic to their website by being the place that investors land when they're asking the question, how do I invest in a small company, then educating them, and then saying, now you've been educated, here's some companies you can invest in. So I think that's already happening. I think it's going to continue to happen. There are hundreds of new blogs being generated by the industry specifically about investing and creating new access to these investments, and I think those are going to continue.
Kurt, when there's a chance, a good break, I'd like.
Just next after Jay Brown.
Perfect.
Yeah, thanks, Kurt. Judith, you may only have 1.3 million people in Maine. I was there for the first time this summer. It's a beautiful state, but what you also have is apparently a near monopoly on blueberries. And which I was completely surprised about. Everybody who buys blueberries doesn't realize it, but they're buying Maine blueberries. I want to ask just a couple of practical questions, about something, obviously with the federal definition, because it hasn't been implemented yet, so it's sort of hard to say, like, what's happening under that. I think the answer is nothing until it's implemented, but we have the state analogs. So I have two questions. One is, do you think any of the portals will actually be broker-dealers, or do you think this will be pretty much run by non-broker-dealer portals? The people the entities have to register with FINRA, but otherwise will not have to qualify for the full panoply of broker-dealer regulation. And then the second question, I'll just toss them out there, is, if I were advising an issuer on this, so going to the issuer side of this, the company side of this, I really wouldn't advise them to issue common stock, because I would say that, first of all, if you do get a subsequent investor in, if it's a big investor, they're not going to necessarily want to see you have 1,000 investors each owning $10 worth of stock or something like that. It's not an attractive ownership configuration. But the other thing is, at least if it's a corporation as opposed to an LLC or something, you have to do every state has an annual meeting of shareholders, and you have to have a notice of your meeting, and you have to send out the notice. There's this carrying cost, of having shareholders if you're only raising a small amount of money. So I tooled around on some of the websites, and I saw that some of them, I think these must be under the state exemption, offer things like profit sharing instruments or something like that, which I take to be sort of not debt, so that you're not legally required to make an interest payment on a regular basis, which you might not be able to afford, but it's also not stock either. Have you seen this stuff, and sort of what are people offering out there? Completely legitimate. I'm not suggesting there's anything funny about it, but I'm sure it's to minimize the cost to the company, of having to essentially hold on to these investors and the legal requirements that go with it. I'm done.
Somebody on the webcast just bought mainblueberries.com, and they're going to crowdfund it later. My answer to your question is, I am certain that people use profit-sharing structures to avoid corporate formalities and other obligations and complications of having a lot of shareholders. If I were to say that the Title III rules could be amended to improve corporate structures for crowdfunded companies, it would be to allow intervening entities, to allow the crowdfunded shareholders to invest in an LP the way they're doing, for example, under the Funders Club No Action Letter in those structures, and have a neater cap table at the common, and give the crowdfunded shareholders a controlling entity in which you could more effectively manage that at scale. But right now, what people are trying to do is solve that technologically. So there are people who are developing post-crowdfunding raise investor relations platforms that are attempting to figure out, how do you manage having, and I'm not sure it's going to explode to 1,000. I tell people that under Title II of the Jobs Act, if you look at the difference between a 506B and a 506C, it's double the number of investors, and that's going from 7 to 14. So I'm not sure we're going to see an explosion like going to 1,000 investors on a cap table rapidly, although it could happen. And if it does, you're going to have to manage that. There's going to have to be technological management of voting processes and other things that's going to have to be facilitated. So I think they're going to try to solve that technologically.
I would actually agree with the technological solution, because we are actually seeing very large numbers coming in the Regulation A offerings. And some of those are, we are talking about thousands, and that is one heck of a job. From a technological point of view, you couldn't have done it 10 years ago. It just wouldn't have been possible. And now it is. So you can just take all of that messy cap table and say others, and they're all held through online. You cannot possibly let all of these people communicate with you, though, or have the right to pick up the phone and call the company all the time. So that's the, I think that is the solution. Then I echo what Chris said. If there's anything any way that we could improve Regulation CF, it would be to permit an LLC or some kind of special purpose vehicle into which we could put all of the crowdfunders and deal with them that way. We didn't answer the broker-dealer question.
Well, what I can tell you, and the one thing I can share with you on the broker-dealer side is that some of the portals in some states have been registered as broker-dealers, and in speaking with a couple of them, they said they actually think they should be. It lends them more credibility and more accountability, so they think it actually benefits them to be registered as broker-dealers. Whether or not that will continue under federal crowdfunding, I'm not sure. And then to the other point, I think that both Chris and Sarah are correct, some sort of technological solution. We certainly have seen entrepreneurs who are now looking more toward a debt offering than an equity, now that they realize exactly how it would operate as an equity offering.
I'm certain that there will be broker-dealers that facilitate Title III offerings at the beginning of the marketplace.
Barb Roper.
Sure. Thanks, Kurt. First of all, I want to thank all of you for coming and for your very interesting presentations. I apologize for not being there in person as I had intended to be, but I'm glad that I was able to participate by phone. I have a couple of questions, and since I am by phone and it's a little awkward, I'll just ask them and then let you respond. The first has to do with something that Sarah and Judy both said, which is sort of the slow start in the context of not having had it taken up yet in Maine. Sarah's prediction that this will start slowly. I'd like, just your more general view on that. And one of the concerns that we have is that when that happens, we often, I think Sarah got the point just right. You can read too much into it on both sides, but we often see, arguments made in Congress, for example, that this is proof that the rules have failed and we need to go back and loosen up further, which, so I'm interested in whether others agree that this is going to start slowly and what the implications of that are. The other point I have is, Sarah, you just reeled off a number of things that you say investors need to know. And I have to say I listened to that list and I have no confidence whatsoever that investors will understand dilution or how the shares grow or the list of things that you just provided that you think are essential knowledge. We have no evidence that investors understand the costs they pay in mutual funds, which is a lot less complicated issue. We've had areas where we have educated for years without evidence that investors actually, across a broad scale, understand those key points that we've been educating about for years. So what are we going to do to ensure that investors know the things that they need to know, given our really very poor record on investor education with regard to a lot less complicated issues than those that we're dealing with here?
Well, I think what I would say, Ms. Roper, with regard to your last point, no confidence that investors are going to understand all of these concepts. From my perspective, that's why investment limits are so important when it comes to this type of offering. At a minimum, we are at least reducing or limiting the potential loss for the investor. I know, and we all know, that one of the most frustrating parts of being a securities regulator is going home at night knowing that you have an investor who's lost a substantial sum of money that you may likely never recover for them. So I certainly think that education always is important, starting at a very young age all the way up until the point we all reach our final day. But in this particular space, I think making sure investors know that your investment is truly at risk. You need to be prepared to lose it all, and that all is a very limited number. I also agree with you that sometimes we are too quick to judge opportunities, and I'm hopeful that we all give both federal and state-based crowdfunding a chance, and all look for creative ways to fully implement them in a way that assures investor protection and supports our entrepreneurs.
Can I just jump in and make one point before you? I was remiss in not saying at the outset, I completely agree on the point about the investment limits being important in this context and for exactly the reason you just gave. And I would be remiss in not noting how much we appreciate some of the changes that were made between the rule proposal and the final rule that reflect recommendations by our committee, including strengthening the limits, including the point on allowing more freedom to curate offerings, etc. So I do, while there are other areas where I'm, less satisfied with the final rule, I would be remiss in not mentioning how much we appreciate those changes that were made in the rules.
Thank you, Barb. We have time for one more question. Steve Wallman or Damon, go ahead.
Yeah. I hope I'll be brief. I wanted the opportunity first to just say to point out to all of you all how fortunate we all are to have Sarah with us today. I served under Sarah in some fashion on the Congressional Oversight Panel for TARP, Kurt, as you alluded to, and the quality of our work, which is something among the things I'm most proud of in my career, owes a tremendous amount to Sarah. And I think we all got a little taste of that in her presentation today. I apologize to the other members of our panel that I'm not saying something similar about you. I don't know you.
I know Judy very well.
I'm proud that Sarah's part of our industry as well, and if we're in this, I'm in the Sarah Adulation Club too. So,
but I want to, Sarah, you wouldn't. I can't let you off quite that easy. Not everybody.
You have to be nervous when he starts by complimenting you.
I've known him for a while.
Not everybody's going to hire you, right? And I think if Ms. Shaw's presentation, I think, really suggests very strongly that we've got an issue here of, and I think even Mr. Tyrell's discussion about how it's in the interests of the sector as a whole that people are well behaved. Right? That has always been true, but has never. It doesn't cover everybody, right? Not everybody's going to hire you. Not everybody's going to. There are people who will see their way toward making money the less reputable way. Given the list of things that you enumerated, which is, I think, proof of the nice things I said about you. Given the list of things you enumerated and that reality which has been present in the securities markets since the dawn of time, what do you think? Do we really have the right regulatory balance here?
No, it is a really good question because much as I would like everybody to hire CrowdCheck, we're not quite set up for that yet. And so the question is, part of what we do is we lead an investor through where they click on bits of the report, say, is there anti-dilution protection? Click here if you don't understand what it is. So how do we protect the people who don't have our reports to click through to? And that is an excellent question. There are going to be people who cut corners because however little money any of our services cost, it is still not nothing, and it's cheaper to cut the corners. I think one of the things we're going to have to do is have the industry work very closely with the states and with the Commission to just tattletale on everybody who is not doing it properly. I mean, I think we do have to become the teachers' pets and the playground squealers, because we see what's happening, and I see it every day. We see it on social media. I see so many scams on LinkedIn. Who would have thought that was going to be a forum for it? But I think all of us have to, and I mean everybody in the industry and all of the regulators, have to be constantly looking out for the bad guys and being willing to bring them to the regulators. And we'd like the regulators, and here, I am a huge fan of the SEC. I am a former SEC staffer. I think they've done a really good job. But there are some things we would like them to move on faster, because it doesn't take very much time to take $2,000 from somebody's pocket. And so a combined industry approach, which could be some kind of formal committee that could be the regulators and CIFRA and the SEC all working together to do an early warning system for things going wrong.
And we've had that same dialogue at the kind of trade association level, and I don't think any of the trade associations want to be in the job of being what I don't know what the most generous thing you said was, maybe playground squealer, but I don't think it's a trade association role. I do think that it's a combination regulators, industry, and industry participants' role to figure out how to identify bad actors early. I recall one email I received from Sarah once in which she forwarded me something with her pithy comment, I think this person's trying to violate all the rules in sequential order. And so there are some bad actors that are so obviously bad actors that we should get identified earlier. There's some really interesting technological solutions, some of which have already been developed by the peer-to-peer debt industry for detecting people through what I'll call guilt by association technology, that when you see fraud on a particular street or from a particular group of people with a particular set of characteristics, you then flag everything that has those characteristics until you can start narrowing down technologically things that look more like fraud from things that look less like fraud. And I think we're going to do over time a better job of identifying early, whether it's by committee or by technological means, where the bad actors are and stopping them earlier. Some people call this crowd intelligence, the ability for all of the people looking at a particular offering to identify and ferret out fraud and other bad actors quickly, because it is going to be the efficiency of the bad actor process is going to become important as this grows and expands.
Thank you all three so much. We appreciate your time and your comments here today. Thanks very much.
Thanks for having us.
All right, our final our session this afternoon is a discussion of the new proposal from NASDAQ on the listing standards related to shareholder approval rules, and Jay Brown is going to introduce the topic for us.
So the next topic involves listing standards. I think we heard Commissioner Stein earlier today mention, let me see if I have these numbers right, 1,750 SRO proposals a year, of which 500 of them have to be approved by the commissioner or the staff. And so, of course, some of those proposals coming from SROs are listing standard proposals from stock exchanges. You know, I'm sure everybody in this room knows that listing standards are a critical source of governance for our public companies. It's where we get the majority of independent director requirements. It's where we get the requirement that you have an audit committee, a compensation committee, and a nominating committee, all of which have to consist of independent directors. NASDAQ requires that. The New York Stock Exchange requires that. There also, of course, are rights that are given more directly to shareholders. The reason that if you're traded on an exchange, you solicit proxies is because probably you're a very good citizen and you do it anyway, but NASDAQ and the New York Stock Exchange require that you solicit proxies. It's not an SEC requirement or a state law requirement. It's a stock exchange requirement. And, of course, there are instances when stockholders of exchange-traded companies have voting rights that do not exist under state law, certainly aren't imposed by the SEC. Really, the only federal instance of voting rights or voting obligations is say on pay, but other than that, voting rights, there are important sorts of voting rights that come from the stock exchanges. We saw recently the New York Stock Exchange asked to do away with voting rights for early stage companies in connection with the approval of certain stock issuances. Stock issuances, I think, to related parties, sort of insiders and things like that. And our very own Rick Fleming, as the investor advocate, not quite wrote a comment letter, but objected in publicly and in writing, or opposed the change. And in the dead of night on December 31st, 2015, the staff of Trading and Markets issued a statement saying, "Thank you very much, Rick Fleming, but we're going to approve it anyway." So today we have a couple of representatives.
So Jay, can you clarify for me, was that approved by the staff or was that approved by the commission?
Staff.
Okay.
So we have a couple of representatives that we're quite privileged to have today here from NASDAQ. Not NASDAQ, but the Listing and Hearing Review Council have issued a call for comments. And what the call for comments is asking for is there are a number of instances right now where there are stock issuances by a company and they have to be approved by shareholders for NASDAQ-listed companies. These come up in connection with the acquisition of stock and assets of another company. It comes up with approval of certain equity-based compensation plans plus material amendments to those plans, change of control, issuance of stock in connection with change of control, and certain private placements depending on sort of the pricing of the private placement. So what has happened is that this call for comment has indicated that these shareholder approval mechanisms, and I'm quoting here, may no longer make sense. They've been around since 1990. The notice points out that since 1990, there have been changes like the requirement that there be a majority of independent directors, and that you have, and a number of other changes along those lines. And they're asking for comments on this. There's no specific rule proposal or anything like that yet, just comments on should we change these, should we do away with them. So we have with us Arnold Golub, who is the Vice President, Listing Qualifications and Deputy General Counsel at NASDAQ. And then we have Stanley Higgins, Senior Director, Listing Qualifications with NASDAQ. And gentlemen, I turn it over to you.
Thank you very much for that introduction. And, my name is Stan Higgins. I'm a Senior Director at NASDAQ Listing Qualifications. The NASDAQ Listing Qualifications Department is responsible for enforcing the NASDAQ listing rules. I'd like to thank the committee for their invitation for us to come down here and to speak to you today about the solicitation and comments we put forward on behalf of the Listing and Hearing and Review Council. And as you indicated, this is not a rule proposal. These rules were put in place over 25 years ago, and we'd like to get opinions from and comments from the market participants to find out and identify those provisions of the shareholder approval rules that are burdensome but may no longer provide the same investor protections that they provided when they were put in place. Now, our listing council is a standing independent advisory committee appointed by the board of directors of the NASDAQ stock market. Their mission is to review the application of the NASDAQ listing rules and public policy issues related to listing, and where appropriate, suggest new or modified rules for consideration to the board. As many of you are probably aware, Ann Sheehan is the vice chair of the NASDAQ Listing and Hearing Review Council. So the NASDAQ shareholder approval rules were adopted over 25 years ago, and in that time, the capital markets and securities laws have undergone significant change. Companies are able to access the capital markets quicker than they were 20 years ago, do offerings in different fashions than they were, offer different types of securities than they were 20 years ago, but the rules that we apply at the stock exchange have not changed since that time. NASDAQ recognizes that our rule book should not be static, just as the public company model is not static. As the capital markets evolve, so must our listing standards. As Mr. Brown pointed out, the rules require shareholder approval in 4 separate instances. In the case of the acquisition of another company, equity-based compensation of employees, officers, directors, or consultants, whenever the issuance results in a change of control, and certain private placements at a price less than the greater book or market value. The rules on equity compensation were vetted with the Commission and other SROs fairly recently, so the comment solicitation will focus on those rules that govern share issuances in connection with acquisitions when they result in a change of control and private placements. Just to be clear, we're not soliciting comments on the equity compensation rules. Since the shareholder rules were established, there have been other investor protection mechanisms that have been put in place, including, for example, the requirement for majority independent boards and independent board committees that review capital raising transactions. As a result, we believe that there may be provisions of the shareholder approval rules that may no longer serve their original shareholder protections. The questions proposed for public comment are the product of extensive conversations with the very market participants these rules affect, including individuals representing our listed companies, long-term shareholders, and the investors who participate in the capital raising transaction. Through these discussions, a couple common themes that were echoed to NASDAQ was the desperate impact the shareholder approval rules can have on smaller companies. Also, the importance of insider participation in capital raising transactions versus the increased costs and delay that result from such participation when the transaction is at a discount and may require shareholder approval. The heightened role now played by independent directors, as I mentioned before, and the sense that under NASDAQ rules, the closing bid price may not be the best measure of a company's market value when determining if a transaction is at a discount. On that last point, our marketplace rules define market value as the closing bid price, not the last sale, not some average. Some of the participants claim that maybe that's not the best measurement when determining whether or not a transaction is done at market value. Markets are very volatile, and in some cases, a market valuation of a company today may not truly represent the market value as a result of certain volatilities within the market. With regard to acquisitions, our questions cover the threshold amounts in the rule that trigger shareholder approval. NASDAQ requires shareholder approval if the issuance in connection with an acquisition is greater than 20% of the shares outstanding, or 5% of the shares outstanding if insiders have an ownership interest in the target. During our conversations, it was suggested that the 20% threshold was perhaps too restrictive, and that a much lower threshold for 5% acquisitions involving insiders was outdated, given the investor protection mechanisms established over the years. With regard to change of control, our rules don't quantify exactly what is a change of control. We simply say that companies are required to get shareholder approval when the issuance results in the change of control. NASDAQ generally determines that a change of control has occurred if the result of the issuance by the company, an investor gains a 20% ownership in the company or a 20% voting power in the company. However, as currently written, the rule does not quantify this 20% ownership or voting power. We ask if NASDAQ should establish in its rule a bright line test. And if we do establish this bright line test, is the 20% threshold right? Additionally, we'd like to know if the market participants believe there are other factors that NASDAQ should consider instead of or in addition to the ownership and voting power. Finally, if you've read the comment and solicitation, several of our questions are related to private placements. Right now, shareholder approval is required prior to the issuance of shares in a private placement equal to or greater than 20% of the shares outstanding at a price less than the greater book or market value. Some of the questions we're asking with regard to the private placements have to do with the use of book value as a test measurement for shareholder approval. We ask, and we would like to know what the investors or the investment community think. What does book value, what investor protection does book value provide in determining whether or not a company should seek shareholder approval? Is it outdated? We don't know. We'd like to get them to tell us. We would also like to know how those who participate in capital raising transactions, if the 20% threshold affects smaller early stage companies disproportionately to those who are larger companies and more established. We find that smaller companies tend to access the capital markets, for example, a pharmaceutical company who's developing drugs in order to continue their research needs to access the capital markets more often than, say, a large, more well-established company. We'd like to know if this 20% threshold in the eyes of the market participants is disproportionate to and disproportionately affects those smaller companies. Keep in mind that NASDAQ is requesting comments on the shareholder approval rules and that all comments are subject. All comments are welcome. One thing I need to point out is as of today, we really haven't seen or have any written comments in-house. So I'm going to ask the committee members here, either individually or as a committee, if perhaps they could put together some sort of written comment solicitation. It would be greatly appreciated. In addition, we would also note that all comments are welcome, including those comments that support no change to the existing shareholder approval rules. We're not out to make change, we're out to find out if change is needed. Now, once we receive all comments, we will review the comments with the Listing Hearing and Review Council. And as a result, after that review, they may result in any and all rule changes. We don't know. We'll have to see what they are.
Stanley, is there a particular due date for these things? Do you have a standard public consultation period, or how does it work?
Right now it expires on February 15th, so depending on whether or not we receive several comments, we may extend that. No determination has been made at this time.
So, excuse me, I'd just like to emphasize a couple of things. Thanks, yeah. I'd like to emphasize a couple of things that Stan said. First, to really stress that there's been no decisions made with respect to changes we want to make to the rules. We've put this out broadly seeking comment, and we really are hoping to get the benefit of people's experiences with the rules. I think in an ideal world, what we're looking for is the intersection of what's unimportant to investors in today's world with what's burdensome to companies in having to seek approval. And at that intersection is the area where we would seek to make changes. With the recognition that the burden on companies is actually a burden and a cost to that company's existing investors, that it results in suboptimal transactions, transactions structured in a way to satisfy our rules that provide no additional benefit to the existing investors, or the cost and the delay in obtaining shareholder approval when those existing investors may not necessarily feel the need to vote on a transaction of that type. The other area where you'll see we're exploring throughout the comment solicitation is what's been identified to us as a disproportionate impact on smaller companies, that the rule that allows a company to issue 20% of their shares outstanding at a discount, a large company, an Apple, an Alphabet, can issue 20% of their securities and raise billions and billions of dollars. A small, newly public biotech company may have the need for significant resources on an ongoing basis, but can't raise that same amount as less than 20%. So we're exploring that impact in particular as well, with, again, the view towards what's important to investors and whether investors have different expectations in investing in companies like that, and whether those rules should be identical.
Yes. I really don't have any more, prepared remarks. I think Robert summarized our comment and solicitation very well. So what I'd like to do is, I guess, open it up to the committee and see if anyone has any questions.
Thank you both very much. I just one real quick question in terms of reading the release and where it says it has been suggested, and I just was curious who are the suggestions on these coming from? Is it from the listing committee, or is it from staff, or?
So prior to putting out the comment solicitation, we've had multiple conversations with the listing council itself and subcommittee of the listing council to explore potential changes. And one of the suggestions coming from the listing council was that staff should go out and proactively reach out to others in the various constituencies. So that's companies themselves and representatives, counsel for companies, that is investors in transactions of the type that might need shareholder approval, and that's long-term holders in companies, institutional investors that hold the companies listed on NASDAQ, with a view towards, as I mentioned, figuring out what's important to them within the rules, what do they rely on, and what's less meaningful. From the investor's perspective and from the company's perspective, what's particularly burdensome and what is the result of that. So we've had, over the last year or so, dozens of conversations with those with people from those various constituencies. And some of the, in those conversations, people threw out ideas, what if you do this, why don't you change the rule that way? And to the extent that you see specific I won't say proposals because we're not proposing anything, but specific ideas that we're seeking comment on in the comment solicitation. It's iterative from those conversations, and we're looking for wider comment on those ideas.
Thank you very much. I'm not sure who was first. Damon?
Thank you. And I apologize. I'm going to have to go after I hear your response to my question. The listing standards that you all have are as the sort of SRO structure has been changed, are really sort of they're core, I think, to the legitimacy of NASDAQ and the other exchanges as participants in the securities regulation system, and the ones that you're looking at here have, I think, in many people's view, been very helpful in maintaining a fair corporate governance system. So this is a non-trivial matter, revising these. And it seems to me, from reviewing the questions, that there are two ideas sort of embedded in these questions that I'm just curious if you guys are clear, you guys are consciously embracing these ideas, and why. One idea seems to be that as opposed to in the past when these listing standards were enacted, that disclosure is enough. That in dealing with potential conflicts of interest and conflicts between existing shareholders and potentially future shareholders, and particularly conflicts of interest between insiders and shareholders, that disclosure is enough without actually giving the incumbent shareholders the right to vote. And that's a change from the thinking that animated the original version of these rules. Secondly, there seems to be an idea here that something has changed in corporate finance such that the NASDAQ's original understanding that 20% is roughly a measure of control is no longer true, and that some higher number will suffice is okay. So I'm curious, what changes in the world would seem to support those two conclusions? I see absolutely nothing in the world that would support either of those conclusions.
Sure. Well, thank you. Excellent segue into what we're thinking. So first, if I could take your point about the SRO model, and we fully support and embrace the SRO model. We recognize that there's, as there's been changes in the SRO model, that there is at least an appearance of conflict when the SRO has to adopt rules, and that's why we've adopted the listing council model. We have an independent committee represented by all the constituencies affected by our listing rules, and that independent committee is required under our bylaws to make recommendations to our board before we make any changes in the listing rules. And we've found that that works very well to the benefit not just of the marketplace, but to NASDAQ itself. With respect to your specific questions, first whether disclosure is enough. And again, I'll kind of go back at the risk of repeating myself that we've made no conclusions already. We've advanced questions. We've echoed ideas that have been suggested to us from various constituencies. But certainly, the federal securities laws are largely a disclosure regime, and we put out the question in that spirit as to whether there are certain instances where disclosure is enough. It's by no means suggesting that we do away with all of our shareholder approval rules in favor of a disclosure mechanism, but it does raise the question as to whether there are circumstances where, given other protections that didn't exist 25 years ago, like the majority independent board reviewing and determining transactions, whether there might be circumstances where a vote isn't necessary, but disclosure might suffice. And again, we've reached no conclusions on that. We have no opinion. We're looking for comment to form our conclusions. The second, as to kind of what's changed in the capital markets, one of the biggest changes has been the speed and the ease with which companies can register shares and conduct public offerings today. It used to be that the registration process was the long pole in a financing transaction, whereas today, with shelf offerings and other advances in the securities, other changes in the securities laws, now it's often the shareholder approval rules that are the long pole. And again, that's not implying that that's wrong or that that's a problem, but we do think it's worth raising the question that, given that it's now the shareholder approval rules that cause the delay in a company getting what could be badly needed funds quickly, is it still appropriate to require approval in those instances? Or do investors see a benefit in all cases that we're requiring approval to impose that timing burden?
If you don't mind, but what about that makes 20% no longer the right number for control?
Well, again, that's a different question. So again, there's our rule doesn't indicate what is a change of control. Our rule says you need shareholder approval when there is a change of control. We've historically looked to 20% unless there is a larger position. As we're opening up these matters for question, given that it's a conversation we frequently have, a company will say, well, your rule doesn't say that 20% is a change of control. Why are you saying because somebody's getting 21%? They're getting control. They still need 30% of the other votes. They're not in control. And we've pushed back on that, but we think it's been asked of us often enough that it's fair to open it up for broader comment.
Thank you. I appreciate it.
I think we're going to have to self-police since Kurt's not here. I have a bunch of questions, but I'll only ask two for now, give my colleagues an opportunity. The proposal that you talked about this afternoon, can you tell me, was that driven unilaterally by the staff, or was that approved by the Listing, Hearing, and Review Committee? And if it was approved by that committee, what was the vote? And tell me a little bit about the background of that committee. You mentioned that Ann is the vice chair, and I would certainly feel good with her judgment. But how many issuers are on the committee? So tell me a little bit about the background of the committee, if you would. So that's one question. I guess there's subparts in there. The second question is, explain to me, the original rule says you can't issue stock at below book value without a vote, right? And so now a question is that might change. So if you could explain to me why you view book value as a less relevant metric today than originally. When I thought about that, Today we fair value much of the left-hand side of the balance sheet. So arguably, if anything, the left-hand side of the balance sheet, which is going to determine book value, is probably going to be higher than it was at the time you originally issued the rule. So it would seem that, if anything, book value is going to be higher today, all else being equal, than it was historically. So why do you view book value as now a flawed measure where originally it was an okay measure?
Sure. So taking your questions about the committee, so if I could recharacterize your question a little bit, because you had asked if the listing council voted on the proposal, and again, we don't have a proposal now. We have a request for comment, and I apologize for keep going back to that, but I do want to be clear that we've made no decisions, no determinations. We're seeking input, and the listing council did review that request for comment and approve the NASDAQ putting it out in their name. I don't recall the vote. I will tell you that I don't recall. I don't believe so. And again, it's it's in the nature of seeking input. Who could be opposed to asking for comment? Who can be opposed to looking for input? Any actual proposal, any proposal to change any of our rules that comes out of this would go back first to the listing council for their recommendation to the NASDAQ Exchange Board, then to the board for approval for us to file it with the SEC, and then it would have to be publicly filed, where it would be open to notice and comment through the SEC's process, and the SEC ultimately would have to approve it as meeting the statutory standards within the Exchange Act. So, again, there was a vote to put this out for comment. I don't recall anybody being opposed to that, although, again, I remind you that it was a request to seek comment and not a request to change any rule or adopt any position.
And the background of the committee?
So the committee is, we look for constituents throughout the community affected by listed companies. There are a number of issues. I unfortunately did not bring the committee membership with me, but it is posted on our website.
Are issuers a majority?
I don't have the membership in front of me. I will tell you there's representatives from issuers. There are representatives from accounting and law firms that represent issuers. There are representatives from academia. There are investor representatives. And we always try to maintain that balance. Under our bylaws, there's a requirement as to the number of what in our bylaws define as public members and non-public members who have a relationship with the exchange, such as being from a market-making firm or the like, as well as other kind of compositional requirements are set out in our bylaws, and those again are part of our exchange registration process.
The book value question?
So onto the book value question. One thing we've seen, and again, this is why we're soliciting comment on this, and have not made up any determination. But one thing we have seen is as there's sector difficulty. So we saw it with financial companies during the financial crisis, that they frequently trade below their book value. So many community banks were trading below their book value a few years ago. When there's been issues in other sectors, likewise, we've seen their trading value below their book value. These companies are going out to raise money. They may be, in some situations, we've seen them raising money above the market price. Companies trading at 80 cents or $8, and they're raising money at $1 or at $10. Yet their book value is higher. And so that's the question is, that we're soliciting comment on, is are investors concerned that if a company is raising money at a price higher than the market price, that would be considered dilutive and a place where they would want to have the opportunity to vote before the company can proceed with what, by all appearances, is a favorable transaction.
At the risk of jumping the line, maybe we'll just go this way. Of course, that means I get to go next. I apologize in advance if any of my comments come across as shrill. They're not intended to. Hopefully they'll be taken in the manner that you guys want, which is honest feedback in what you're proposing. And I'll start with the bigger picture point and then maybe move to some specific issues that are raised. And I absolutely appreciate the procedural posture in which we are both here, and thank you for coming, because we really do appreciate it. As well as in terms of the request for comments, that this is very much at the conceptual stage and not at the full proposal stage. Of course, the fact that the conceptual stage even exists suggests that there will be a proposal, and insofar as having an investor perspective, my guess is you will be proposing to ease the standards, not make them more stringent in terms of requiring more shareholder votes. Is that the general, am I right about that?
That's not accurate at all. We have no preconceived notion. I think, in an ideal world, again, I kind of go back to my comment earlier. We're looking for kind of the intersection of what's unimportant to investors and burdensome for companies. So, I have no problem, saying that we might strip away, if the comments identify those types of situations, that we might strip away areas where approval is needed today that's unimportant to investors. By the same token, the rules always reflect a balance, and I think if there are areas that are identified where the rules can be strengthened, where approval isn't required today, that it should be. I can't speak for the listing council, but certainly the exchange staff is not adverse to modifying the rules in that regard.
Well,
I
that's
think
very,
you saw
very
that.
encouraging.
You saw that. Our last significant changes to the rules were with respect to equity compensation, where we significantly increased the circumstances where a vote would be required.
I appreciate that. Nonetheless, my prediction is, to be honest, is that we'll go in a different direction. It'll be more lenient and less stringent. That's just my own comment. And I appreciate your and your colleagues' progress, particularly in equity compensation. The skepticism that I bring in terms of my perspective here really comes from the point where the SRO model has evolved from being a quasi-regulatory model to, in fact, an appendage to for-profit enterprises such as your company. No longer is it the case that NASDAQ or NYSE are effectively non-for-profits established for the benefit of market participants and both shareholders and issuers, but indeed are themselves issuers and public companies in the same regard. And I must tell you, my experience both as an advocate for large corporations as well as an investor, I've been stymied by these rules. Transactions that I myself have sponsored have not gone through because shareholder approvals were required and were too remote or too hard to get, and as a matter of fact have had to do the kind of structuring and come to at least what in my view as a profit-seeking person were suboptimal. But nonetheless, I think on the whole, the current balance, particularly the 20% threshold, is totally appropriate and should be unmolested. And part of my own concern is animated by the reality that what we've seen very late, including with Rick's own efforts, is a sort of race to the bottom on listing standards. New York Stock Exchange might point to a NASDAQ standard and say, well, we should be at least, even with them. And certainly, I think, I don't have to speak for Rick, he spoke for himself, that turned out to have been less good or bad, as a matter of fact. And on the other hand, I think there are a number of technical questions here that are absolutely worthwhile exploring. So, for instance, the last bid price, I could absolutely agree would be an odd peg for which one would peg the entire value of a company, and a volume-weighted average price over a reasonably short period may be a better measure. And certainly there's potential for technical improvements that would make it both more easily administered and perhaps more reflective of the investor protections in the way they were intended. I don't agree with the statement that there may be rules that are no longer serve investor protections the way they were intended at the broader level, however. I take no comfort whatsoever that there are majority of independent directors and lawsuits that are possible as elements of protections for shareholders, because fundamentally what we're talking about here is dilution. And that's the biggest issue, and to some lesser extent, although a meaningful extent, changes of control with no premium being paid to the incumbent shareholders. So those are the two basic normative elements that we're trying to protect against here. I think most of us would agree to that. And it gives me no comfort that a majority of the board is independent as a shareholder to think that I may have been diluted or some control may have passed, if not de jure control in the form of 50%, but certainly de facto control. The Delaware cases, and this are fairly clear, that a number of cases find that issuances or transactions or just incumbent holdings in the 20 to 30% range, depending on the degree of concentration of holders and the balance of the shareholder base, do qualify as de facto control, and are instances where when transactions happen, courts actually impose fiduciary duties on those controllers. I don't think that it makes sense, at least from my own point of view, to change that. And I have the august distinction of having bought in excess of 20% in the open market on a number of occasions of economic interests in companies and have had to suffer the consequences. So I think those, on balance, are good rules and should remain unmolested. While I totally appreciate the internal mechanism by which these kinds of changes are promulgated by the NASDAQ, I'm delighted you have a listing council, even more delighted that Ann is the vice chair of it. But at the same time, that's an internal mechanism that you guys have set up in order to deal with the appearance of a potential conflict of interest. That conflict being more specifically that as a for-profit business, lowering listing standards and making your marketplace a more attractive place for companies to list will of course improve profitability and the economic outcomes for your own constituents. That is very different than the constituents who are trading in the market on your marketplace. They don't share the benefit if more companies list on your exchange. But to Damon's point earlier, I'm not sure there's much of anything that impacts my normative view of what is protective of shareholders that's changed in the marketplace from 1990 forward. As a matter of fact, I think stability of rules over a long period is actually very beneficial because we all come to the nuisance. Anyone who decides to list on your market knows that this is an issue. And innovation because of longevity of a rule is in no way, in my mind, a justification for, in fact, molesting a long-standing and I think very, very good rule. I'll suggest to you as a matter of process that it's going to be difficult both for this committee and anyone else to comment on this sort of conceptual draft because they're not sure what they're aiming at. So it's very hard for people to say, you know, no, you shouldn't change 20%. Yes, you should, although I've just done it. They'd rather aim at, you know, something very specific. So if you're going to 15% or 25%, it's going to be a little bit easier for people. So it's not. I'm not that surprised you haven't seen a lot of inflow. And this forum, you know, you'll get some feedback as you already have. It will be probably unsatisfying for you as people have to then go walk with this down the halls. But nonetheless, I think you're going to have a hard time, which is not your fault. That's just the world is hard and people are busy. And absent something to aim at with any specificity, you're going to have a difficult time. But I'll say in closing, I think 20% is a fantastic threshold. I think we should keep it. I don't think we should change it in any way. I think how we measure value, whether it's book value or market value, probably on the margin could have some improvements. I myself would look to a volume-weighted average price over something like a 5 to 10 trading day period, and probably not longer than that, for that purpose. And I don't think you guys, well, let's put it this way, if and to the extent you decide to move forward and propose rules, I think you need to strengthen the logical nexus that you seem to have put forward that says there's something about the governance environment that's changed so dramatically that these protections may be either superfluous, redundant, or in some way unnecessary. The fact that, I'll say it again, that, you know, the majority of independent boards sort of put to a side, but the fact that people can sue after the fact and that we have leakage in the system, whether it's through attorney's fees and whatnot, is cold comfort would be a very charitable phrase to describe that protection from a shareholder perspective. And that's it.
Well, thank you for those comments, and whether you know it or not, that was enormously helpful, and the type of feedback we are in fact looking for. So.
A couple quick things. Sort of following a little bit on what Roy was saying. You know, if you all do this again in the future, one thing I would recommend is that you say something actually affirmative that says, yes, we're looking at these and these voting requirements, but if you've got any ideas of places where we should increase voting requirements, I mean, do a declaratory sentence that actually says that. You know, one of the optics that we've been dealing with in this committee are proposals that we get from different places that seem one-sided. Now, I concede yours doesn't say we're only looking at it from one perspective, but when you have lines in there like we're concerned about the cost of capital to companies raising money, it's very suggestive that what we're looking for is how can we loosen these. So I hear you when you say you want to hear both sides, and if we have ways in which we can tighten this, you want to hear those. But I would say that. I would let people know affirmatively you want to look at both. The other thing I think with what Roy said is we have to assume that once you guys put something out and if it gets approved, the New York Stock Exchange is going to come right behind you and say we want this too. You know that they completely redid their governance structure with respect to NYSE regulation, basically got rid of it and formed a committee of its stock exchange, which is the way you guys are structured. And their argument for it, one of their big arguments was NASDAQ does it. And then this proposal that Rick Fleming was debating here inside the commission, also one of the main arguments was New York Stock Exchange was NASDAQ does it. So I think we have to assume from now on that every time somebody comes in and does something that I would describe as reducing the power of a listing standard or making it less protective of shareholders, the other exchanges will come right behind you and do it. So they're not just approving it for you. They're going to have to. It's tantamount to approving it for everybody. The only thing I would add to that is the statement in here that says one of the changes has been a majority of independent directors. You know, the Wall Street Journal just on Wednesday, I think, wrote an article called "Boards Get More Independent, but Ties Remain." And it was a whole long list of, Lubin did it, and it was a whole long list of relationships between directors, independent under the exchange rules, and officers, right? And there was no implication that they didn't meet the definitions. They did. It would be people who used to work for the CEO 5 years ago or something and don't fall within the definition now. But they were talking about all of these ties that all of these people have. And you know, I participated when the SEC drafted Rule 10c1, the rule for compensation committees and imposing the listing standard on the stock exchanges. And one of the things the SEC had the authority to do was define standards for independence. And some of the commentators, including myself, wrote in and said one of the factors that should be considered are outside business and personal relationships, that should be an explicit factor in the listing standards to be considered for director independence. And both NASDAQ and the New York Stock Exchange said no, and was not required to be in the listing standard. So I offer that to you only to say I don't view this independent director board thing as something that is really sufficient to replace what I would call a material shareholder protection. I just don't think it's a practical matter. You know, that it is one of the changes since 1990 that you guys note, I think, accurately, but it's not. It in my mind doesn't suffice. You know, on the margins or something, I don't know, but certainly to take away, for example, the 20% approval requirement or the approval of, you know, of benefit plans or something like that. I don't think it is. I don't think it replaces the need for the shareholder protections in this area.
Well, thank you. If I could just respond to one point in terms of the definition of an independent director. The NASDAQ rule defining an independent director is two parts. We list objective tests that preclude anybody from being considered an independent director, things like you mentioned, past employment within 3 years, compensation from the
consulting
company.
And all that, yeah.
Right. But we also have an objective standard that imposes a requirement on the board to consider all facts and circumstances and any other relationship that may exist that would impair the director's independence. So, you know, the board does have the affirmative responsibility to consider those social relationships you mentioned and make a determination as to whether it impairs the director's independence. We
You know,
don't have
it's
a
not
bright
explicit.
we don't have a bright line rule,
Right.
because every situation is different. We can't put ourselves in the boardroom. We think the other independent directors, properly empowered, are in the best situation to examine the facts and circumstances of that company. But it's not true that companies don't have to consider that. It is part of the subjective determination that each board has to make in considering who.
There's no question that that's right, and the reason why the exchanges said don't put it in the rule is they have to consider it anyway. But when a law firm does a questionnaire to directors, they pretty much take the listing standards and reflect them in the questionnaire, and they say, do you have any of these relationships, including do you have any other material relationship with the company, which is the broad standard that you're talking about. But if you don't have in the listing standard and you have to consider outside personal and business relationships, and I submit if you look at that Wall Street Journal article, what you're going to see are some outside business and personal relationships among the directors and the officers. I don't know whether, and I've seen enough examples when things have become public, I don't think all boards consider, you know, do in fact, there was a case in Delaware where the director that was labeled independent would go to the March Madness with the CEO, and they would go out and stay with each other at Christmas. You know, they had a close personal relationship. I'm not so sure boards are screening for that, and there's nothing explicit in the listing standards that say to them do it. So it's not a failing. The requirement is there, but it's not strong enough by virtue of it not being explicitly, in my opinion, being mentioned in your listing standards, that it ensures that all boards actually take that into account.
One quick suggestion. I've had a number of people contact my office wanting a copy of your request for comment. It's very difficult to find on your website, so that might explain why you're not getting a lot of traffic. And I have a number of questions, but I'll chop them down to just one instead of beating some of the horses again. I guess the thing that I would like to know is whether you currently have some exceptions in your rules for sort of emergency situations. So one of the things that you said is that some of these are designed to help a company that needs to get badly needed funds quickly. But are there other rules, are there existing rules that have sort of a emergency valve, if you will, if the company's really in trouble and needs to raise capital?
Yeah, so we do have a exception to the requirement for shareholder approval that when the company's financial viability is threatened. So that's a case where literally the alternative to this transaction is the company declaring bankruptcy. And in that process, there's typically nothing left for the existing shareholders, and it's something we enforce very carefully. I'll look to Stan or my colleague Nikolai there that it's been no more than 2 or 3 over the last 2 or 3 years that we've allowed companies to do that. They do need to ask us first before relying on it. They also need the approval of their audit committee to rely on it, and they also need to tell their existing shareholders 10 days in advance of issuing the shares. But to get the approval from us is a process where the company has to walk through all of their efforts to raise money in a manner that would comply with our rules, and show us that the failure to do the one transaction they have in front of us would result in their needing to almost certainly declare bankruptcy. And again, the policy behind that is that if the company declares bankruptcy, then the existing shareholders are left with nothing. So giving them even a bad transaction instead leaves them with something. And then there are these other protections built into that as well, the audit committee approval, the prior notification, which lets them vote with their feet, if you will, that if they hate the transaction so much they can at least have the ability to sell their shares. So it's a very narrow circumstance. We do, and for the benefit of everybody, maintain a very transparent process whenever we issue an interpretation of our rules, including an interpretation that says this financial viability exception is allowed. We post a summary of that transaction on our website. We wait 90 days to distance, so to distance from the transaction, so nothing identifying is disclosed too soon. We also anonymize the transaction by taking out the name of the company, the name of the investor, anything like that. But we do put up the summary with the material terms of the transaction on our website, and we have all the times we've issued this financial viability exception available on our website as well. If you search in Google the NASDAQ Listing Center, that will bring you to the page that has all of those interpretations.
Thank you. We'll wrap up with a question from Steve Wallman.
Actually, a couple of observations and points maybe. And first, I would probably be the last person to suggest that any rules adopted in the mid-'90s are not perfect as written. But quite honestly, that is a long time ago. And I think it is actually useful to consider whether or not the world has changed and whether or not rules should be updated and modified appropriately. So I actually think this is a good idea to seek comment and figure out what makes sense. I do agree that I think there is some sensitivity to tone and concerns about whether or not views are already predisposed to come out a certain way. So you may want to consider that as you move forward. It would also be, I think, very helpful if you're going to be talking about burdens to issuers to actually explain what the burdens really are. The cost of solicitation itself is probably not sufficient to outweigh taking away a shareholder approval process that otherwise is perceived as having some significant value. So presumably it's other things than just the cost of solicitation that actually is relevant in terms of your viewing a burden as being something that's too burdensome. Some of the other things, just to make sure that I think we're all sort of thinking about some of this stuff, when you look at the financial crisis that we've gone through, there were a number of companies where the amount of, in essence, securities being issued, although not necessarily ones that would have tripped your specific rule, but certainly in much greater amounts and with much greater dilution, were done without the same notice, without shareholder approval, and certainly without the timeframes that you're talking about. We, as a society, thought they actually made sense and that they were there to rescue the whole financial system and others as well. So there are certainly examples on the other side where a company being able to go out and get capital in short notice, even if it's quite dilutive, has been perceived as something worthwhile, and that the shareholder approval process, had it actually been imposed at that point, would have been potentially quite horrific for a number of certainly the issuers and the follow-on knock-on effects that would have occurred afterwards. So I do think these are rules that have sensitivities on both sides. Personally, having practiced in this area specifically, I think the rules personally are actually quite good. I think that the shareholder approval process was a worthwhile benefit. Personally, I don't see some of the presumed substitution that comes from independent director activities or some of the other things that you mentioned. Certainly lawsuits are not a sufficient substitute. In many of these cases, the companies aren't big enough to have traction from somebody to actually want to bring a whole lawsuit in order to protect themselves. And it may make more sense to just retain the rule. But I think there are things worthy of consideration there as to, is there a way to make the rule more streamlined, more effective, or is there something else that can be done? I will tell you from the very beginning, Joe, to answer your question, I never understood, and I saw it come into effect, why there was book value. That seemed like a mistake to begin with. It sounded like what was happening back then was people needed something to peg it to. Market value was not very good. And so book value seemed like, what the hell, we've got to come up with a number, and it's as good as any. I think today probably the world's moved a little bit beyond using book value as the actual market value of a company, and maybe there are some changes to your rules that would make an awful lot of sense. And I also agree with Roy's perspective on using a spot price in today's market is really not sensible, especially given volatility generally. But I do think this whole effort of looking at these issues is actually important. And I think having a framework of saying, what are we actually trying to do? What do we think is going to be effective? How do we think it can be made more effective so that we actually try to improve the system is very valuable. And I would disagree, I think, perhaps with some of my colleagues on the notion that, if a rule was put in place 20, 25 years ago, we ought to stick with it unless we can demonstrably show that it's something terribly wrong. I think that's too high a standard. I think that the world keeps changing. We certainly as a committee keep proposing new changes to either existing rules, recently adopted rules, or rules that we think should be adopted merely because the environment is changing. And I think I'd like to encourage everybody to do that. I think we should all be thinking about how we can continue to improve as opposed to being stuck at a place that was 20 or 25 years ago. So I think from that perspective, it's good.
Thank you.
Thank you both very much for being here and presenting, and for your time today. It's very much appreciated. Thank you to all of our presenters. Thank you, folks, for being here. And for those of you here and on the web, our next meeting is April 14th, same time, same place. So we'll talk to you then. We are adjourned.